I am a believer that we are going into a soft landing. I think that there's a lot of cash on the sidelines today that even at these rates is going to come back into the system.
The markets have now priced in what I think is probably excessive interest rate cuts in the U.S.
The Federal Reserve, if anything, is going to err on the side of holding interest rates.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro, together this week with Annmarie Hordern. The title of this forum is Rebuilding Trust. Bramo, it should be Operation Pushback from central bankers worldwide.
That seems to be one of the biggest themes we've heard again and again, whether it was Christine Lagarde or whether it was Dan Pinto of JP Morgan coming out and saying, stop it. We're not going to cut rates that much. Here's the tension. Either you don't have the soft landing and you have the rate cuts, or you have the soft landing and no rate cuts. Pick one, and no one really wants to do that.
The last 24 hours has been absolutely fascinating. You've had President Lagarde here in Davos doing a wonderful sit-down conversation with Bloomberg's Francine Lacqua, pushing back. You've had Governor Waller in the last 24 hours pushing back. Not on the idea of rate cuts this year. We should say that up front. This is about the timing, Lisa, and how much they deliver in 2024.
And their commitment to really bringing inflation down. I'm glad that you brought up Chris Waller. He was talking about how this cycle they're not going to cut rates as aggressively in the past just because of some of these structural inflationary forces. Similar kind of commentary from the ECB. Here's the question. What will it take for the market to believe them? And if that's the case, where are those rate cuts going to come from? Are they going to come from disinflation, or are they going to come from weakness that maybe we're seeing from places like China?
This has been a monster theme for the forum already this week. Another theme has been, if you have an American accent, you will be asked about former President Donald Trump. And Annmarie, the prospect that he takes over the White House in the next 12 months.
Yeah, absolutely. It's the elephant in the room, or the Swiss Alps, is whether or not the former president is going to come back and what kind of legislation or what kind of policies he wants to enact. One big thing that really gets, the hair on the backs of people up is the fact that he wants a 10% tariff wall around the United States. So that's the vengeance Europeans are concerned about.
Big morning for us for foreign policy. We'll catch up with David Cameron, the British Foreign Secretary, a little bit later on in the programme. Mark Rutte of the Netherlands as well. NATO. Two big issues. We've got to talk about the war in Ukraine, Zelensky's arrival in the last couple of days, and we've got to talk about the tension in the Middle East.
Yes, absolutely. These are two of the big geopolitical risks that everyone is concerned about, not just, spreading and creating wider conflicts, but also what does it mean for the economy going into 2024?
Lisa will go through the morning ahead. Let's start with the price action. Equity futures, again, negative. We're down about 0.5% on the S&P 500. Just a touch of weakness to start the week, Lisa. You see it again on the screen on the S&P.
And we do get, of course, retail sales in the U.S. coming up later this morning, but we do have a roster of incredible guests, so that really is front and center. We talk about international policy. John Kerry, U.S. Special Envoy for Climate for the United States. We do believe that he is going to be stepping down. We will have a discussion with him. Ronald Kruszewski, CEO of Stifel Financial, Dave McKay of RBC, the CEO there. And right now, I got to say, Ann Walsh, the CIO of Guggenheim Partners, speaking about why she's pushing back also against market expectations, but maybe not in the same direction as everybody else.
Let's start that conversation right now. Ann Walsh, the CIO at Guggenheim Partners Investment Management. Anne, good afternoon. How are you?
I'm well, thank you. Thank you for having me.
Hey, thanks for being here. Let's get straight to it. We've had some people call it a pipe dream. Other people call it laughable. The amount of rate cuts priced in for 2024. Where are you on that one?
Well, our camp is that we still see a recession coming, and although our base case is a mild recession, and as a result, we still see rate cuts. And we are actually predicting that they start sooner rather than later. And I know now that's not exactly the mainstream opinion, but we see a lot of softness in the economy coming ahead, and that leads us to our outcome.
Where do you see that weakness right now? What's guiding you?
So I think there's really two economies happening in the U.S. right now. We have the established markets, the larger businesses, those with access to capital. And then we see the 50% of the GDP, which is small and mid-sized businesses. And that part of the economy, and particularly in manufacturing, is slowing down. We're having a bit of almost a rolling recession already. And as a result, I think there's real risk into what I would refer to as the real economy.
Is there going to be one moment where people sort of say, aha, we see the weakness, we understand why the Fed is cutting rates, and it is not because of a soft landing? Is it going to come from something like some of the regional banks, like what we saw last spring?
I'm very concerned about the regional banks. I'm not concerned about the large banks, the SIFIs. I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space and a refinancing wall in their commercial and industrial loans. And I think that this is going to cause them to have to, really take risk considerations very carefully, and I think the lending capabilities that they're going to have and the capacity that they're going to have to lend is going to be very limited.
From an investment perspective, how do you express this? Do you just avoid regional banks? Do you just avoid commercial real estate? Do you just pile into money market funds?
So as a fixed income investor predominantly, it's a good time to buy investment grade fixed income. The up in credit quality trade has been a good one. You certainly aren't being hurt with yields north of 5% in investment grade fixed income. And even within the public high yield space, the higher credit quality within that, the BB rated and so forth, is performing well. We've seen spreads tighten. There's been less issuance in 2023. I expect that to continue in 2024. And so as a result, credit has been a popular place to be and will be, I think, a very solid place to be in 2024.
I want to talk about the geopolitical risks, and we have what's going on in the Red Sea that's affecting global commerce. There's also this war in Ukraine. Yet, when I talk to foreign policy experts, they say, and foreign policy leaders around the world, they say the biggest risks are emanating from Washington, D.C., the stable of democracy. Do you take that view?
Well, I think there's a very significant increased geopolitical risk. At this particular moment in the markets, tail risk is higher, and it can come from any number of places. That's one area. The uncertainty. Markets do a poor job of pricing in geopolitical risk until the event of whatever, the triggering event occurs. And so what we see right now is a great deal of concern over what's coming. That's going to introduce volatility. I think that's going to continue in 2024. So it's not going to be a steady rate of anything. We're not going to see inflation come down on a perfect trajectory. We're not going to see markets perform perfectly. We're going to see volatility. But the trajectories are in place for lower rates, for less inflation, but not on an even keel, if you will.
This is the difference between shocks coming from within the financial system and outside. So let's build on the shocks coming from outside. I joked at the top of the programme that if you've got an American accent this week, you will be asked about the former President Donald Trump. You've experienced that firsthand at this forum. What do you say back to people?
I have about as much expertise on what the outcome could be as anybody else. There's a lot of months between now and November. I expect that if the trajectory continues, Donald Trump will be the nominee for the Republican Party. Biden will be the nominee for the Democrat Party. And then it's a reprise of prior years. So it's challenging to see what's coming. I think the markets will start to price in, based on surveys and polls, what the potential outcome will be to policy. And so we'll start to see that as we get into the second half of the year.
Let's get into that. What does pricing in another Trump term actually look like? We all remember that moment overnight in 2016 where initially equity markets sold off, and then there was this acceptance speech and the former president started talking about infrastructure investment. And I remember just sitting there on the Bloomberg terminal and watching him futures start to click higher. Then all of a sudden, next couple of weeks kicks in. Price sets narrative. It's the Trump trade. Is it that all over again, or is it different this time from your perspective?
Well, I think it's different this time because we do have some sense of what the policies look like. There will be more exported oil. There will be more. There will be deregulation, presumably, and there will be other aspects to the policy. I would anticipate the continuation of the tax cuts, the Trump tax cuts. So as a result, I think we'll have at least some playbook, and the markets will have an expectation built in.
How much do you feel like people are trying to get deals done now ahead of that's almost the pressure that's getting people to galvanize their activities in the moment before November?
I'm not really sure I'm seeing that. And if you think about M&A activity, I'm not really seeing that. It's picking up a bit, but I'm not sure that it's going to be back to pre-COVID levels. I don't really anticipate a whole lot of energy to try and get ahead of the election at this particular time. Do
you think the Treasury market would accommodate these kind of policies again? I think what we've witnessed in the previous administration and the current one is they're very comfortable with big deficits. Do you think this market is very comfortable with big deficits for the foreseeable future?
I think we're paying a lot more attention to fiscal policy than ever before as a result of the fiscal spending that's going on in D.C. And I don't think either party, being elected is going to change that. Both parties spend. The question is, what do they spend on? And President Trump was not a hawk on spending. So I would consider that would be the market should build in an expectation that will continue.
So just to come full circle, you were saying that as one of your hedges, or as one of the havens for you from some of the geopolitical risk, from some of what we might see with smaller and regional banks, you're going into high-quality credit. You're going into fixed income. At what point is that no longer the hedge if you expect sort of inflationary types of policies to continue regardless of who's in the White House?
Well, again, I think that there's parts of the economy are slowing down considerably, and we also see inflation is coming down. We see rates coming down. Now the question is, what happens after we achieve the 3.5% that we're targeting on the 10-year? Well, we would say, absent fiscal spending, absent Treasury issuance, you could see rates lower. But we don't, because we think that the level of Treasury issuance and the level of fiscal spending keeps a floor under the rates in the long end of the Treasury curve. So 3.5% is a rally from here, but at the same time, probably puts a floor under any further rally.
You've been cautious on risk assets for a while. I know that you've been coming out and saying you've been expecting some of the pain to become more apparent. What surprised you most about why we haven't seen that?
Well, I think upon further reflection, what we didn't anticipate was the sheer volume and amount of liquidity that was still in the system, and it had to be purged before the markets would become more rational. For example, global central banks have pulled $5 trillion out of the system globally since quantitative tightening started, and that's an immense amount of liquidity that's exited. We're just now starting to feel the effects of that, and I think that delayed the impact of the tightening and rate hikes that we saw from global central banks.
Favorite trade this year, outside of credit and investment grade?
Rates. We're positive again on the Treasury curve, and I do, again, anticipate the short end will be coming down as well as the Fed starts to cut rates.
Interesting. And this was great. It's good to see you.
Thank you so much.
Thank you for joining us to kick off day 2 at Davos at the World Economic Forum. That was Walsh of Guggenheim Partners Investment Management. Lisa, we need to think about this, the new policies that we could see from a new administration, if indeed the former president becomes the lead candidate, looks like that right now, for the Republican Party, and wins again. Do we see a repeat of what we saw back in 2016?
Christine Lagarde seems to think so. We've heard from others saying that they seem to think so, which means a more sort of nationally focused, more tariffs, and a lot more sort of investment in fossil fuels and other things like that. At this point, do we also still see a rally, or is there a new deficit concern and geopolitical risks?
Well, to Ann's point, Trump loved to spend. Nikki Haley continuously mentions this, $8 trillion under his administration. So to say that Republicans want to rein in deficit, someone like Donald Trump, that's not always true. But this protectionism, that is the concern of the Europeans and some other members here.
For about 5 minutes, I think we were super fearful of what was happening with Treasury markets, Annmarie. Is that even a campaign issue out of Nikki Haley? Outside of Nikki Haley, is the electorate excited about the prospect of someone coming forward and doing something about the deficit?
Fiscal hawks within the Republican Party and potentially some hotshot donors are very interested in what she has to say because they're watching this. And I continuously come back to this stat. In about 10, 12 years, the United States will be paying more on their interest payments than even their massive defense budget. This is a problem that Washington loves to talk about, but no one actually wants to get down to the nitty-gritty and deal with.
And it's because voters don't want their Social Security cut. They don't want any of their Medicare and Medicaid cut. So if you don't have any discussion around that, how can you have a real conversation?
This has been a huge issue amongst all these town halls DeSantis and Haley are doing, because on Bloomberg, Joe and I asked Haley about this, and she said 65 is way, way too young. And now she's backtracking because people at 65 say, hey, I want to retire. I'm not waiting till 70, 75.
They vote, and it's not popular. It's as simple as that. Coming up in the next hour, Steve Tananbaum, the founder and CIO of GoldenTree. Plenty still to come this afternoon from Davos, Switzerland. Good afternoon. Live from Davos, Switzerland, for our audience worldwide. I hope the mics weren't hot just then. I hope they weren't. Equity markets look like this afternoon. Equity futures on the S&P 500 negative again. We're down by 0.5% on the S&P. Negative yesterday as well on the Russell, the small caps. Bit of drama. No drama, Bramo. We're down about 1.3%.
Everyone's just focused on what's going on in Davos, clearly. No, I mean, honestly, the story has all been about sort of pushback from some of the rate-cutting expectations and also pushback from some of the enthusiasm that we started the year, or ended the year, I should say, with last year.
So we're in the commercial break, and I don't remember saying whether it was off the record or on the record, but we asked Secretary Kerry what his next move would be. I'm not going to tell you what he said. He's joining us now. He's going to tell you himself. John Kerry, US Special Presidential Envoy for Climate. Secretary Kerry, good afternoon.
Glad to be with you.
Yeah, it's good to see you. I won't repeat that. I won't repeat that. I want to start here. This is a delicate time. You're a seasoned diplomat. We've got wars in Gaza, wars in Ukraine, and seemingly, from the outside looking in, I think perhaps an inability or lack of willingness to restore order from the US perspective. Is that what's going on? Can you tell me your perspective on things? I think it's deeply valuable. Can you tell me whether you think this is an inability or a lack of will to restore global order?
Well, I'm not yet out of the job of climate envoy, and that's my lane, is dealing with climate. So, but I will tell you unequivocally that President Biden, I think, has done an extraordinary job of holding people together in the midst of a very complicated period of time, perhaps as complicated as any of us have seen, certainly in recent years. But if you look at the difficulty of sort of rebuilding NATO, which is what he had to do after the last administration, and then holding NATO together with respect to Ukraine, and simultaneously managing several other potentially explosive situations, which could lead to greater conflict, much wider conflict. And I think he's been navigating that together with Tony Blinken in an extremely effective way. These things don't change just like that overnight. And you need a ripeness to the ability to be able to negotiate something different. The negotiations in Ukraine, for instance, I suspect they could get ripe, but they're not yet. Likewise, in the Middle East, I think the administration has been crystal clear in sending messages to the Prime Minister and to his war cabinet about how they think the operations in Gaza ought to be carried out. And it's not with indiscriminate bombing and the level of deaths that we've seen now. So I think the president has been very clear here, but also, thank God, that he has the years of experience he has from the Foreign Relations Committee and as vice president, and now as president.
There's a lot to unpack there. Can we just start with NATO? You mentioned NATO and rebuilding NATO. When the former president said what he had to say about NATO, he wasn't wrong. There were a lot of members who had promised to invest in defence that were falling short continuously. Has that changed?
It has changed, but it still has to be fulfilled. The promise has to be fulfilled, the 2%. And but look, again, we have a myriad of major global challenges. Let's talk about one of the biggest that doesn't get to a daily focus of Ukraine or of the Middle East, but it's killing a lot of people. The climate crisis is killing just air quality alone. We lose about 7 million people a year who die because of the bad air quality. You look at what's been happening last year, 2023, the single most disruptive year in history of measuring climate impacts. Fires, floods, massive rainstorms, greater intensity to storms, the heat, which people can't live in, massive numbers of refugees already, and that could grow worse as it gets warmer, which it is going to, because we're not moving fast enough to curb the impacts of unmitigated burning of fossil fuel. So there's only one cause of this crisis. It's the unmitigated burning of fossil fuel. And we in Dubai, 195 nations strong, including oil and gas producing countries, including ours, all signed up to transition away from fossil fuel, to do so in keeping with the science, which means trying to hold 1.5. That's a pretty rigorous standard. To do so, keeping 2050 net zero. Yeah. And finally, to accelerate our efforts in this decade. That's a pretty big mandate, folks.
At the same time, the U.S. is pumping more than 13 million barrels of oil per day. It is a record amount. It has been credited for offsetting some of the geopolitical risk. Do you think that that's a policy failure or a policy success?
It's a policy necessity because you obviously can't shut down the economies of the world and be ridiculous in sort of saying, oh, okay, we don't, you know, you're going to affect demand without affecting supply at the same time. You've got to have a broad approach. That's what the administration is trying to do. For the moment, you have to try to keep the economy stable and keep the price low enough that you don't have revolutions in countries all around the world because the gas prices are $10 a gallon, whatever it's going to be. So you've got to have some reasonableness. But that has to be accompanied by a very clear set of policies that are moving in the direction of this transition away from fossil fuel, that are therefore deploying renewables faster, that are putting new technologies out there in order to mitigate. If we don't do that, then it is a mistake and it contributes to the problem.
But a lot of people...
But I think we're going to do that, and I think we're doing that already right now in many parts of the world.
A lot of people talk about what the future is. Joe Biden's talked a lot about electric vehicles, but we've seen a lot of companies pull back from electric vehicle production because there isn't the demand. Do you get the sense that there is a successful, coherent policy that has been prescribed by Joe Biden to achieve what you're talking about while also pumping record amounts of oil?
Yes, there has been a very, very clear policy, which regrettably has been attacked by people who are engaged in high levels of disinformation. They've been trying to scare people about the range of vehicles, so there's range anxiety out there. But in addition to that, you've had some pullback because communities aren't moving fast enough to give permitting to deploy some of the renewables that we need. So you've had wind farms that were going to be built that have now taken years longer than was calculated in making the deals, and people have had to recalculate now how that deal's going to work. So the answer is we have to, all of us, embrace this transition. If we're going to take 5 and 10 years and have years of litigation over whether or not you're going to have a renewable plant somewhere nearby, we're in trouble. We're not going to get there. And we have to accelerate that, and that's a lot of the message right here in Davos.
Just to jump in, it's difficult for me to believe that the poor EV sales are a consequence of a misinformation campaign about range anxiety. Let's take Hertz. Not my view of the car rental company. They come out and they've got to dump 20,000 EV cars. They don't just talk about rebalancing supply with demand. They talk about the cost to carry. It's really expensive to keep these vehicles.
Sure.
It's really expensive to go and buy one. I think what we're seeing is a reality check, not just about the ultimate destination, but the pace at which we get there. A reality check because for most everyday Americans, they can't afford this.
Let me tell you what's happening. The price is going down as the price of renewables has gone down. The price of renewable solar has gone down 83% in the last years. The price of wind has gone down 50% in the last years. The price of lithium has gone down something like 97% in the last years. And we do need to send stronger demand signals to the marketplace. Now, we have an entity here that we've created a number of years ago called the First Movers Coalition. We have 100 of the top corporations of the world in this First Movers Coalition. That includes Apple, Microsoft, Salesforce, Boeing, FedEx, Ford, General Motors, a whole bunch of major American and other international companies. And they have agreed they're going to pay a green premium voluntarily in order to send a market signal to have green steel created now. Volvo has said, we'll buy 10% of our steel that's going to be green. So they're making green steel. Cement is now on sale in Lafarge Holcim, largest cement dealer in the world. They're making green cement. And it's better cement. People are buying it not because it's green, because it is better. So we're seeing a movement towards a rational transition with those biggest companies. And I'll tell you, if the CEOs of those companies can persuade their boards and their shareholders that this is a valuable enterprise, then more people are going to buy into this over a period of time. This is a transition. It doesn't have to happen overnight. There will be ups and downs. There will be bumps in the road. But I'm telling you, EVs now, there's a sufficient level of penetration, about 92% in Norway. Major levels in China. The front page of The Economist has a big picture of, electric vehicles from China coming in towards the United States. And those are selling for something like $22,500, and it's going to become a bone of contention. You watch. We'll have some discussions about that. But the point I make is this will even out over time. General Motors and Ford and Mercedes and Volkswagen and Hyundai and Toyota, these companies have all spent billions of dollars retooling their plants. I'm telling you, I don't care. It doesn't matter who comes in. Whoever the president of the United States is or a public official is, those CEOs are not going to suddenly go back and say, oh, let's go back and we'll make...
Of course not. They're ready on a plan. But we talk about the materials to make an electric vehicle and the negative externalities of these. These raw materials are in Africa, and then they're processed 85% in China. We're talking about serious manufacturing issues, labor issues, human rights issues. How do you weigh that against carbon emissions?
Well, we always, President Biden, I think, more than any president in recent time, has been fighting for the rights of workers, and he is constantly, as you know, referring to unions and union workers and defending the rights of workers to be able to do better. So, but those materials you refer to, sure, that we're going to go through a transition. There's a lot of lithium in Mexico, by the way. Cobalt, nickel, these are the things we need. They're not all in Africa. And now the National Security Council of the United States, under President Biden's direction, has focused in on these critical minerals. And I think you're going to see the balance of where they come from and who has them change, mostly because of market forces. The marketplace is going to support this transition. And I think it's irrevocable now. There's no question about whether or not the world is going to get to a low-carbon, no-carbon economy. We're going to get there. The only question is, are we going to get there in time to not be ravaged by the worst consequences of the climate crisis? And that's not me talking. That's the best scientists in the world who have warned us. You've got to do these things now, or it's going to cost you more down the road.
Let's end on President Biden. There's reporting that you're stepping down to actually go work for the campaign to get out the climate vote, the youth vote. How successful do you think you can be in that position when the youth think that this is a president that is too old and too out of touch to lead them, especially also when it comes to a foreign policy issue like Gaza?
Very fair, and it's a great question. But let me begin it by saying I'm not stepping down in order to go to the campaign. I'm stepping down because I think that what we've done in terms of Dubai is so powerful in terms of encouraging this transition that it's going to open up a whole new set of opportunities which are important. And mind you, I came for a year. I've been there for 3. I think it's time. I will campaign for President Biden. I will certainly, because the stakes could not be higher for our country, for the world. The stakes are as high as they get, and as high as I've seen in the course of my public service. So I am going to campaign very happily because I think he's done a terrific job. He's shown experience. He's kept us from, having a complete breakout of uncontrolled war in many regions. But at the same time, he stood up for American values, global values, universal values, for America's obligations with respect to Ukraine, the Middle East, and elsewhere. And if you've listened to Secretary Blinken and the President in the last days, they've been crystal clear about expectations for what needs to unfold in the West Bank, in Gaza. And I think young people around the world will see an administration fighting for the rights of people to get the medicine they need to have, to be safe, and for the Palestinian people to have a future, even as Israel is absolutely protected as it needs to be.
Secretary Kerry, we appreciate the robust exchange. Thank you, sir.
Thank you.
I'm very concerned about the regional banks. I'm not concerned about the large banks, the SIFIs. I'm very much concerned about the small and mid-sized banks. They've got several risks happening at this point in time. They've got commercial real estate and a refinancing wall in that space and a refinancing wall in their commercial and industrial loans. And I think that this is going to cause them to have to, really take risk considerations very carefully. And I think the lending capabilities that they're going to have and the capacity that they're going to have to lend is going to be very limited.
Still very concerned. That was Ann Walsh, the CIO at Guggenheim Partners Investment Management. Just in the last hour, Bramo concerned about regional banks, which for many people we've spoken to so far this week feel like that was just the story of last year and the banking sector is in a better place.
Right. What did we hear from Cantor Fitzgerald, right? It's going to be an amazing year for the banks. Everything's going to come back. You're going to have a real strong recovery, even without rate cuts. Some people, including Ann Walsh, still worried about commercial real estate, about smaller businesses, and that really is still a question mark.
And looking for Treasury yields to drop to about 350. Check out the market right now. Equity futures on the S&P 500 lower again. Equities lower yesterday. Soft start to the week. We're down 0.4%. Yields just in at around 4%. The range is pretty tight to start the year, I've got to say, on a 10-year, Lisa, 4.058% this morning.
And the yield curve compressing. It's sort of de-inverting, right? And what does this mean? We don't know yet. And that, I think, is one big point of contention at a sort of tipping point in terms of economic data.
It's pushback week in Davos, Switzerland,
Indeed.
Isn't it, on both sides of the Atlantic? I just want to reflect on that brilliant exchange earlier on today in Davos, Switzerland between ECB President Christine Lagarde and Bloomberg's Francine Lacqua. The market might make it harder for us because the market's pricing in cuts before we'd like them to. Look, you're saying quite a bit out loud. We've been talking about this now for a couple of months.
They talked about this, about the idea that if the markets get too restrictive, that's essentially a rate hike being implied into the market. Does it work the other direction? If the market is basically pricing in rate cuts, does that basically resolve their ability to move because they are looking at a market that's already moved for them?
So much coverage this week of financial services. We can continue that right now with Ron Kruszewski, the chairman and CEO of Stifel Financial. Ron, good afternoon.
Good afternoon.
Good to see you. I think you told investors recently that the slump in deals was like Groundhog Day. Is it Groundhog Day here in Switzerland?
Actually, I don't think it's going to be Groundhog Day. Last year was. I had earnings calls 5 in a row where I said the same thing I said the previous call, which was green shoots, the market's going to get better, everything's great. And then I woke up one day to Sonny and Cher, the song, and I knew I was in Groundhog's Day. But I actually think we're going to have a better year this year.
What are you seeing that's changing?
What's in changing, the market, and as I've been listening to some of your guests, and it's interesting to me about the diversity of opinion about rates and stuff. Where we stand on this is that we think earnings are growing. The street thinks 11%. We think half. The street thinks that rates are going to be cut 6 times starting in March. I'm not there. Okay, I can tell you why on that. We think 2 to 3 times, but that is the definition of a soft landing. Cutting rates into a growing market. Now, every hard landing starts with a soft landing, and so if some of your other guests are right about recessions, well, then that changes the game.
Well, Ann Walsh was on earlier, and she thinks that we are probably heading toward a bit of a harder situation, and that's why we will get rate cuts sooner. She's concerned about regional banks, particularly because small and medium-sized businesses are not doing as well. Do you share her concern?
Not really. I think the banking system has gone through a very difficult 500 basis point increase in short rates, the related deposit sorting, the some of the credit concerns. I mean, there's always concerns, but today the regional banks are stronger. Of course, if you have a real credit meltdown, it's going to impact a lot of people, not just the regional banks.
When you talk about credit meltdown, I was just noticing that we're having the busiest January issuance for investment-grade bonds going back to 2017. How much are companies front-loading this ahead of the election? Are front-loading all of their deal-making ahead of what they're expecting to be a lot more turmoil later in the year?
I don't know if I'd call it front-loading. We've been in a recession in investment banking, equity investment banking in the United States for almost 18 months. And the uncertainty with the rate curve, the inverted rate curve, all of this put an absolute damper on capital raising, whether it be debt or equity. And today, there's a little bit of certainty back in the market, and so what you're seeing is activity picking up. That's why your guy from Cantor was excited. That's why I'm telling you, I think that next year is going to be
better. It was more than just excited.
Was it?
Just a little bit. Just a little bit. Coming out of the pandemic, things were busy. People were gearing up for a lot of activity. They were hiring. You talked about the recession in banking, certain parts of banking. Are we done with the so-called right-sizing, a word that here at Bloomberg Surveillance we hate because ultimately it means job cuts? Are we done with that now, do you think, on Wall Street?
You know, I think what's happened on Wall Street, I do. I think that, in fact, you're seeing a lot of people hiring. In fact, some of the people are hiring are very optimistic as to the rebound that I think we're going to see. But I think that the right sizing is done. You know, in the overall economy, though, what has happened is we're burning through the job postings, and versus, you know, the overall employment is changing a little bit in terms of economic activity. But again, most things point to a rather sanguine environment, which is good for, certainly good for my business. Take some volatility out of it.
Are you hiring?
We always are hiring.
Okay. I figured that you might say that. I'm curious, as you look forward, what's the potential risk case that you entertain most aggressively right now to this case, that we're going to get a soft landing, that you're going to get business come back up, that the certainty that people have now maybe gets shattered a bit? Well, the market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time, especially without a recession. Before we just had rate cuts, 11 straight rate cuts, and we're going to have 5 going the other way in a matter of months. I'm sorry, hikes. It's okay. I confuse it all the time.
Yeah, I do too. The yields go up, prices go down, something like that. But right. So anyway, you know, the long
carry on.
Basically, yeah. I only run an investment bank. All right, what the heck? But yeah, I can get that right. But the point is, I think one of the risks is that the market is pricing in some aggressive rate cuts, and that supports PEs and that supports valuations. And if you don't see that, you could see some of the PEs and the big tech stocks get hurt a little bit. But the real risk is probably geopolitical, and I'm not sure. All they're talking about here in Davos is, it's my first time, is, you know, this is the epicenter of globalization. Yet, if anything, we're fraying at 80 years of Bretton Woods and globalization, and that could have, geopolitical and real tensions could have impact on the market that it's not discounting today. There's no way.
So given that backdrop, where do you see the biggest growth for you this year?
For Stifel? You know, we're going to grow everywhere and always, okay? And so, look, hey, I've been CEO for a long time, all right? I don't know if I've got to let you guess, but it's a long time. We started, when I started, we had $100 million of revenue. Today, we have $4.5 billion of revenue. So we're gaining market share. We're just named J.D. Power's #1 advisor satisfaction. That's a big deal for us. So as I look forward, I see continued growth.
Can we pick up on one spot?
Yeah.
The startup economy. Just felt like it got decimated in the last couple of years. We saw SVB go under, certain banks, perhaps your situation, maybe looking at an opportunity there. Have you seen the startup economy pick up? Again, you were talking about a rebound in 2024. Is that happening?
Well, it is. I mean, part of the issue, certainly SVB didn't help. They had a big market share. They were the bank that they went to. But we, for example, have hired 40, 50 people to service that market. So we have a big presence in both the Valley and on the East Coast, and we're filling that void. And I see that picking up. What really happened in that market was all the money that came into the economy in 2021 just got pushed to a lot of companies that didn't need it and at valuation levels that were not sustainable. So we're working through that as these companies' cap stacks get redone. Again, it's going to lead to activity in the business. So look, I'm optimistic. You can, have me back, and then you can tell me how wrong I was. All right, I won't come back. But no, I am optimistic. I think that. Well, look, last year wasn't fun. All right, so let's be clear here.
Ron, it's good to see you.
Hey, good to see you. Thanks
Yield
for
up,
having
price
me.
down. Fantastic to get the education from Ronald Kruszewski there of Stifel Financial. It's good to see you, Ron. Coming up a little bit later, Steve Tananbaum, founder and CIO of GoldenTree. The market conversation will continue with equity futures pulling back just a little bit here, Lisa, on the S&P 500 for a second day.
With the biggest risk really coming to fruition just a bit, or at least hoping some of the Fed officials and ECB officials hoping that, which is maybe not as many rate cuts as people previously expected.
Yeah, real pushback in the early part of this forum in Davos, Switzerland. The conversation on markets will continue. Stay tuned for plenty more. Throughout this afternoon, we'll catch up with the Dutch Prime Minister and the British Foreign Secretary a little bit later in Bloomberg Surveillance.
I am a believer that we are going into a soft landing. I think that there's a lot of cash on the sidelines today that even at these rates is going to come back into the system.
The markets have now priced in what I think is probably excessive interest rate cuts in the U.S.
The Federal Reserve, if anything, is going to err on the side of holding interest rates.
The 6 rate cuts, that's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance, the second hour, alongside Lisa Abramowicz. I'm Jonathan Ferro, together this week with Annmarie Hordern. It is day 2, and on day 2, in the last 10 minutes, I have to say, Lisa, just a bit of optimism from the CEO of Stifel.
Which is interesting because he is exposed to a lot of the economy that Ann Walsh of Guggenheim was talking about, and just saying absolutely not. He's been in Groundhog's Day again and again. Maybe we'll see green shoots. Hey, guess what? They're here. He feels like maybe this is going to be a better year.
It's hard to be optimistic beyond that when you start talking about policy. Annmarie, and politics.
Yeah, absolutely, especially when it comes to geopolitics. You had President Zelensky here, his last shot really at begging the business world to help rebuild Ukraine's economy, and also to the U.S. Secretary of State and National Security Advisor Jake Sullivan. The president today is going to make his own pitch to the Republicans in Congress for this.
Big push with Zelensky in town. Lisa, let's talk about that, the foreign policy issues and how market participants are going to think about them. You know how these conversations go, and I think a lot of people at home are frustrated with them. Big risk this year. Response, geopolitics. Tell me what that means. What are you doing with that in mind? And then it's like blank face, blank face.
Well,
don't know.
That's essentially what it is. It's just a deep uncertainty. I mean, it was oil prices, right? Well, oil prices have fallen to about $70 a barrel. If you take a look at other issues, whether it's gold, okay, gold's been a mystery asset class for quite a while. If you take a look at disruption to risk assets, and the debt didn't happen. So at what point are you looking at something that is an exogenous risk that you can plan for, or that you simply just ignore and hope for the best?
Looking forward to the conversation through the next couple of hours. Lisa will give you the day ahead in just a moment. I want to turn to the markets just briefly. Lisa, looking at equities, down again on the S&P 500. Down yesterday. Pushback from Governor Walsh yesterday. Pushback from President Lagarde this morning. We're pricing in too many cuts, seems to be the feeling from policymakers.
So instead of an 80% chance that we're going to get a March rate cut, we now have a 62% chance of a rate cut. So, I mean, it's not as if this is exactly getting priced out of the market, but a little more anxiety sort of coming out as people parse through just how much of a price-to-perfection market we're looking at.
In the bond market right now, the yield's up by not even a basis point. We're totally unchanged on a 10-year, 4.058%. Bit of a shift in the last 24 hours. I'm not going to completely sweep that to one side, but I'd say some stability in the Treasury market in the last few weeks relative to what we saw, let's say, in October of 2023.
Things haven't been swinging around by 20 basis points every day. Today, we're going to be having fantastic conversations. We already have, I've got to say. It's been a tremendous lineup. We're going to be speaking with the RBC CEO, Dave McKay, Chuck Robbins, Cisco CEO. But right now, I've got to say, Steve Tananbaum of GoldenTree Asset Management, I'm really excited to get his view on the private credit craze that we've been hearing about here, as well as where some of the incredible opportunities are.
Did you hear the whistle of the train?
Yeah.
That was pretty wild.
That was. I thought that was the craze that you were alluding to. I was like, wow, that's good. You have, like, you know,
sound effects.
On craze to order.
Steve Tananbaum joins us now, the GoldenTree Asset Management founder and CIO. Steve, good to see you.
Thank you, John. It's great to be here.
Let's talk about that massive gap between markets and what the Federal Reserve seems to be implying, what their plans are for 2024. Everyone's weighed in on how we're going to reconcile things. How do you think we will?
So, starting the year, it seemed like you could, at best, get only 2 out of 3. You could have unemployment below 4, growth in the U.S. in the mid-ones, and 6 rate cuts. So it was trying to square that, and that's against a backdrop of a deficit of 5 to 6%. So it just didn't seem to make sense. And then you had a melt up into this belief. So now we're having a walk back. You know, if it was close to 80% at the beginning of the year, now it's 60%. There's a walk back. I think we're probably halfway through the walk back. So I think there's more to go, but you certainly have the easy move right now.
You wonder where that leaves markets. Equities close to all-time highs. Credit spreads still pretty tight when you look at high yield on any given day.
You know what? On the credit spreads, I'm fine with them. In terms of single B, double B, you're still getting pretty good value. One of the ways I like to think of value is what's your spread versus expected default. And at 350 and 7 3/4, given what we expect for the default rate, you're still getting around, call it 200 basis points of excess yield. So I think you could be 50 to 75 tighter in a more benign environment. So the actual spreads don't concern me.
So basically you're talking about how people are saying the biggest risk is that the Fed isn't going to cut rates as much as people expect. You would disagree, and you would say it's that the economy turns down, and that would be a bigger risk. Am I taking that a bridge too far?
A little bit, because there's always stuff to do. But right now, it was priced nirvana, perfect environment. So if the economy slows down, there'll be winners and losers. But right now, particularly ending the year with the melt-up, there's just too much broad optimism.
Well, when you talk about the broad optimism, everyone who we talk to here has been talking about alternatives, private credit. John Rohde did a whole forum on how everybody wants to get into private credit and the expansion of this field. You've been dealing in markets that are less liquid for a long time. Does it concern you that everyone's piling in without necessarily the same kind of quality checks that you might get in a public, more transparent market?
So the short answer is yes. The short answer is yes. And the historical returns that you've gotten, around 300 basis points of excess return, I'm skeptical you're going to get that in the future. In terms of what is private credit, first is used to be smaller companies called enterprise values of less than $1 billion, $500 million. That's actually expanded. When we look at our private credit book, it's about $500 million of EBITDA, enterprise values of, call it, $3 to $5 to $10 billion. So it's a much larger market. It's when you look at who issues private credit, it's private equity is the largest issuer. And the idea that they're going to leave 300 excess basis points on the table, long term just doesn't seem to, it's nonsensical. So we don't expect that to last. And also there's a lot of competition. Now, when we look at our private credit returns, we had a great year last year. We're seeing interesting stuff. You're going to be solution providers, providing acquisition, financing, providing asset liability financing or liability management financing. So I think there's certainly needs for it. It's where the most innovation in credit is right now. It's a really important point that when you look at like a structured products in the 90s, there was a lot of innovation. Right now, private credit has a lot of innovation. But generically, the excess return, I'd be surprised if the next 5 years resembles anything like the last 10 years.
Solution providers, let's build on that. You're a solution provider if you buy AT1s, and you were last year. It felt like that market might have been killed off by Swiss authorities. You took a different view, a contrarian bet, it paid off big time. Can we just start there before we talk about contrarian bets for 2024? Sure. What did you see that maybe others didn't?
It's simplistically the AT1 market's vital. Having owned banks, and we've owned a couple banks where we've been large equity holders, it's private banks. It's a really important financing alternative. And particularly when you have situations which are precarious and you don't necessarily want to put down more equity, having a hybrid security is a really valuable alternative. So the idea of, if you of eliminating that and having the hybrid security actually be a hedge you lose and tails I win type of investment, because if it doesn't work, you get the same downside, and if it doesn't work, you have no protection. And if it does work, your upside is less. Doesn't seem like a good alternative for the regulators. So our view was simple. Simple names are already working. This market's going to come back. The regulators, and we had a strong view since we've had a couple of these banks that have already been regulated, that they are very much in favor of having a lot of choices. So we felt that was a relatively easy trade. In fact, what I felt my biggest mistake was thinking it might last longer than it did.
It sounds easy now looking back at the time. It was not easy. I think, Lisa, you and I were talking about this at the time. It felt like maybe we'd see a real loss of faith in some of these products, these securities.
I just remember just seeing the valuation tank.
Big time.
So it sort of goes to the whole idea of easy money being made. It's really easy to say that in retrospect.
There's nothing easy about this.
So one of the interesting things, this was against a backdrop where the return on equity of European financial stocks was going to be the best it's been in easily since 08, since the crisis. So that was also another nonsensical. So you have really good earnings. the profitability, whether it's through cleaning up the balance sheets, we saw that during the pandemic, there weren't excess charge-offs, to being levered to higher rates. So the return on equity had gone from, call it, if you look at the SX70, had gone from, call it the mid-single digits to the double digits. And then the AT1s weren't going to work. That just didn't seem to me fundamentally to make sense. Or maybe to put it a different way, I've never seen that happen in my career, you know, where the junior securities haven't done well when the underlying profitability is improving.
So is there anything else that's like that right now? Just you can tell us. There's nobody watching.
The easy money for
Exactly, please. Thank you.
You know what? I do think the single B, strong single B, double B is very reasonable. I think the preferred market, so when you look at DirecTV just did a deal in the high 400s. I think that's reasonable. You look at a Valeris, an oil service company, reasonable. So I think that there's a whole bunch of names that are, call it in the high single digits, loan to value of below 50%, that I think are very reasonable compared to equity values. You look at the preferred stocks, also very reasonable. Some of the larger issuers that are trading around 9–10%.
Do you think that credit is going to materially outperform equity this year and has the potential to for a prolonged period of time?
It usually does early in a cycle, with the pandemic being the one exception. If you look at the past few cycles, I think it's certainly a reasonable asset class still. When you look at, it's a higher quality asset class than it's ever been in terms of the mix of double Bs versus triple Cs and single Bs. And you're getting, the index is yielding about 8%. So that's not to say you won't get better opportunities, but as a entry point, I think it's a reasonable entry point.
Steve, everyone in Davos has been talking about the elephant in the room, which is the former president potentially coming back into power. How are you thinking about business if that was to be the case?
So I view this as like game 4 of an NFL season. Okay, so it's really hard, to think about who's going into the Super Bowl, who's winning the Super Bowl when it's only the 4th week. So I think there's just too much to be decided. If you look back the first time, there was a lot of concern, apprehension that didn't necessarily materialize. So, but there's just a lot of data points to look at, who the running mate is, etc. He's proven to change his perspective, and so it's really hard to, in the 4th week of the season, to be placing too much conviction in anything.
There's a guy I've got a lot of respect for, Mark Dow. He's in the market, and he always said back in 2016, it's really difficult to divorce your political bias from your market views. Yeah. When it came to 2016, I think the ultimate success, or at least the ultimate successful playbook, was just to try and divorce exactly that. Focus on the policy and don't focus on the volatility that comes with the man. Can you do that this time around?
Listen, always easier said than done.
Absolutely.
My guess is it's only the 4th week, and we're tired about hearing the scenario analysis played out. So my guess is a lot of these themes will be beaten. And then it's also, it's really unclear what the independents, which are the largest group that they've ever been in terms of the electoral body. So or the U.S. population. So I just think that it's really hard to focus until you're, I'm going to say, 60 days out, 90 days out.
It's Monday night. It's October. Apparently.
Yeah.
We can't talk about the Super Bowl yet.
Well, we will talk about the Super Bowl. I think that everyone here is just sick of it.
Hey, Steve, it's good to see you.
It's great. It's great.
Thanks for catching up with us. It's fantastic. And congratulations on this success in the last 12 months. Stephen Tananbaum there of GoldenTree Asset Management, taking that contrarian view on contingent convertibles in Europe.
I loved that trade, and I love that you asked him about it, because it did seem
love that
like
he's like, it's so easy.
I know, exactly. But it felt like the sky was falling, and everybody said it looked like the Swiss regulators just killed off this market single-handedly. Forget it. Get out. And you saw all these asset managers do that. And who was on the other side? This guy.
Without a doubt. Coming up next, in the next hour, Amir Yaron, the Bank of Israel governor, the Dutch Prime Minister, Mark Rutte, and UK Foreign Secretary, David Cameron. All of that still to come, live from Switzerland, from Davos, at the World Economic Forum. This is Bloomberg.
for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downsides. But we have to be extremely attentive and anticipate, just as we do with inflation.
That was ECB President Christine Lagarde speaking with our own Francine Lacqua on the potential concerns of a Trump re-election. A little bit earlier on today in Davos, Switzerland, Governor Brian Kemp, Republican from Georgia, spoke to us about Trump's big win in Iowa.
That was a strong win in Iowa, no doubt, but some really bad weather, very low turnout. So we'll see what happens here in the next week.
When you look at the election, what are you looking to understand whether Trump 2.0 is going to be the same as Trump 1.0? Is this going to be a different type of presidency from everything that you've gathered?
Well, look, I don't know. You probably have to ask him about that. I've said for a long time now, we need to be forward thinking. We need to tell people, what we stand for, what we're going to do. We don't need to be looking in the rearview mirror and relitigating the 2020 election and really, lay out for the American people what it is we're going to do for them to help fight through, 40-year high Joe Biden inflation, disaster at the border, the weakness that we're seeing in the world, and a lot of other things. And that's what I've been urging the candidates to do, and that would go for former President Trump as well.
But former President Trump wants to relitigate 2020. He was just talking about it last night. He goes back to your state of Georgia, as you know. He wants Fani Willis, the district attorney, to be removed. There's lots of questions about potentially a relationship she had with the prosecutor. How are you going to weigh in on that?
Well, I didn't say always listen to what I said. I was just saying what my thoughts were, and that's for every candidate to decide. But look, there's some... months ago, I was warning people there wasn't evidence to go after Fani Willis, but now there's some troubling things that have been, accusations that have been made, and I think the judge will get to the bottom of that. That's playing out right now. We've got a legislation we passed for district attorney oversight that ended up in the courts, and so we're going to have to re-legislate that this year, which we're in the process of doing right now in our legislative session. But there's ways to address that, and we need to let the legal process play out.
But do you think Willis should be removed?
Well, I wouldn't be able to speak to that because I haven't seen the evidence. But I think at the very least, if the accusations are true, it is very troubling, and I feel certain that the judge will rule in the right way to make sure that, President Trump and anybody else is being treated fairly.
So let's go back to what the timeline is going to look like for the political space in the United States. You say a lot of those candidates are not ready to coalesce just yet around the former president. What I'm hearing is everyone's waiting for New Hampshire. Let's give Ron DeSantis, Nikki Haley some space. But if Trump wins New Hampshire, is that a time when you're going to say, OK, I'm ready to endorse him?
Well, I think it depends on kind of what happens, how big a win it is. If that happens, if somebody else wins, what happens? I mean, I wouldn't want to speculate on that. I know I'm staying focused on the great state of Georgia.
Very diplomatic. Governor Brian Kemp of Georgia there weighing in on the former president of the United States, Donald Trump, and the prospect of him taking back the White House. Let's have that conversation right now with Mark Champion of Bloomberg Opinion joining us from London. Mark, as you know, as you can tell from the outside looking in, lots of conversations here about the potential future president being Donald Trump, what that would mean for European defence. Mark, can you help us understand what the Europeans have been doing for themselves over the last 4 years? Have they been boosting defence spend? Are they in a position to depend on their own military and not America's?
Yeah, that's a slightly graded answer to that. First of all, they have been increasing defense spending more or less since 2014, with the first annexation of Crimea by Russia. The question is whether they've been doing enough. That's a very different question. There was a huge wake-up call in 2022 with the invasion of Ukraine, a lot of commitments to do enormous amounts, $100 billion promised by Germany, for example, for defense. But the actual delivery has been much, 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 less than that. It has to be said that, last year, the U.S. had been taking the lead in arming and financing Ukraine. But by the end of the last year, the Europeans had overtaken the U.S. quite handsomely and were doing the lion's share of the work. It's a fairly complicated question. You know, one thing that's clear is that the Europeans will know what to expect when Donald Trump is elected in that sense. You know, if he's elected, then they will know that, you know, he's no great friend of NATO, he's no great friend of Ukraine, and he's no great friend of theirs.
Mark, let's talk about those billions of dollars and that aid that's been going to Ukraine right now. $100 billion stalled in Brussels and in Washington. Biden today is going to make the pitch to House Republicans that they need to sign off on this. But I want to get a sense from you. You spent a lot of time in Ukraine before and during the war. How much longer can Ukraine go without that aid coming in from Western allies?
Well, you know, the Ukrainians will go on fighting no matter what. It's just that it will be a lot uglier. They will lose a lot more people. And eventually, you know, if they don't have artillery, essentially, if they don't have artillery shells, they don't have the barrels to replace, you know, on the guns, they simply won't be able to compete. And the Russians will be able to push forward, you know, probably quite slowly, but it will be brutal. And, you know, the great thing is to understand, I think, that until the Russians feel that there's no further they can go, the war will continue.
Mark, we're talking all about sort of global kumbaya at a place like Davos, which celebrates globalization and cooperation. How much, though, when you look at the individual countries in Europe, are they also struggling to really get on board with Ukraine aid, also struggling with how much they want to get involved with the Red Sea and fighting the Houthis, and also kind of pushing back and saying, we need to really focus on our own countries and making sure we can compete in a new era?
Yeah, no, absolutely. So you know, the problem in Europe is that you just have one country standing in the way of the release of 50 billion. That's Hungary. And, you know, in the coming weeks, that will probably get sorted. You know, either Hungary will be brought around or it can be circumvented by taking the fund outside of the EU institutions. So one way or another, that will probably be done. But you know, the other things that you referred to, these are perennial issues for Europe. You know, with the Red Sea, the French said they didn't want to be part of a coalition where they might be led somewhere they didn't want to go by the US. And, you know, more broadly, the French have been pushing, you know, for a long time for a kind of you know, autonomous strategic, you know, strength for Europe where they would be able to act without the US. But they're still such a long way away from getting to that point.
Mark Champion of Bloomberg Opinion out of London. Mark, thank you. Kumbaya. You know, I get the feeling that this time around, I don't feel that anymore.
No, I don't either.
Lisa, I've been coming here for much of the last decade or so. Haven't been here since the pandemic. And I get a real feeling that they've had a massive reality check at a place like the World Economic Forum. That the globalists, as people like to call them, that come to an event like this, have seen their model fracture. And they've seen, in many places, not just fracture, but views they used to have break, because they've been so challenged. I think for a lot of people in society, the credibility of a lot of these people is absolutely shot. And trying to rebuild trust, I think the theme of this year is really, really interesting. I know what it's meant to mean, but rebuild trust with who? I think we need to rebuild trust with society at large between the establishment and the people, because throughout the pandemic, that broke big time.
It seems like there is sort of the establishment and the people, and that's the political angle. And then there's the business angle, and people are here just to do deals. And we could see that. And the politicians who are here are also here to do deals, like Governor Kemp looking to meet with some of the auto manufacturers more globally. So to me, this has really just turned into what the meat of it was, which is a deal-making opportunity to rapid-fire meet a lot of people at once. And yes, the parties and all of that, but it seems much more transactional and focused.
Well said. I see it exactly the same way, and I think the conversation we had with Mike Wirth of Chevron was a great example of that. And again, this morning, we've seen that time and time again. Governor Kemp of Georgia is pushing his state to have a much bigger role in the US economy. From Davos, Switzerland, this is Bloomberg. Live from Davos, Switzerland this afternoon. Good afternoon. Here's the price action on the S&P 500. Softer yesterday, lower again today. We're down on the S&P. We're down across the board. On the Nasdaq by 0.4. On the S&P 500 by 0.3. The small caps negative by 1 full percentage point. A bit of negativity, some pessimism in the first couple of days of the week as central bankers worldwide push back against rate cut expectations. In the bond market, 2-year, 10-year, 30-year. The scores in the Treasury market shaping up as follows. Yields unchanged. At least we're on a 10-year, still with a 4 handle. On a 2-year, let's call this 4.28.
Basically, this is not moving at all compared to what it was doing back in November and December. I just want to sit on Governor Waller's questions for a moment, his comments, where he really pushed back. He was reiterating what we've heard from every single person who's come on this set over the past couple days. And to me, at what point do we price out something more than just a 62% chance of a Fed rate cut in March, but maybe something that's less than 0.5%?
Let's get to those comments from Governor Waller. Under surveillance this morning, Fed Governor Christopher Waller calling for rate cuts later this year. Waller saying yesterday, quote, "When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully." The comments easing traders' bets for cuts starting in March. More Fed speak coming later from Tananbaum and Williams. All of that still to come. Lisa, the message, I think they're all on the same page. They have varying different ideas, I think, of how much we should do this year, when that should begin. But ultimately, the pushback is March is too soon and 6 is too much.
And this time is different. And this, to me, really stood out from Chris Waller's comments. He said, with economic activity and labor markets in good shape and inflation coming down gradually to 2%, I see no reason to move as quickly or cut as rapidly as in the past. This time is different because they're not facing off with a crisis, which means that soft landing that everybody is looking for does not come with 6 rate cuts or even 5 or maybe even 4.
It's not just pushback taking place on that side of the Atlantic, on this side as well.
Yeah.
ECB President Christine Lagarde with a few things to say about ECB policy. What she's saying is what we've been asking. When the market starts to tell you this is how much you're going to cut by, the market makes it difficult for you to achieve your inflation objectives through the easing of financial conditions. That's not just a story for this Fed in the US, it's a story for Europe and the ECB.
And the fact that she said the quiet part out loud, does that mean that people start to believe it? Because on the margins, you're seeing yields creep up in the Euro region once again, but not significantly, and you are seeing deals getting done, like what we were talking about, what Davos is about, right? The deals are getting done, and it's feeling more optimistic than it did over the past couple of years, much maybe to the chagrin. It may be moving too quickly.
We heard that from the Stifel CEO. I think this conspiracy theory that somehow these people here have the world on strings. Annmarie, they wish they had the world on strings. They don't anymore at all.
No, when you look around, especially with some of the decisions that have been made or the lapse of judgment we've seen or, you know, a missing of a Secretary of State by a certain president and administration, to think that there's some conspiracy theory and cabal going on in Davos just get thrown out the window. But to Lisa's point, deals are being made on the sidelines, but also this Davos has really become a foreign policy forum in some ways as well. You have almost every single foreign secretary here. We're going to be speaking to David Cameron, and President Zelensky is here. And he's really trying to rally the West once again as they go into 2024 without the money they need to continue fighting Russia.
Let's talk about that right now. Zelensky meeting with leaders in Davos in a bid to shore up his country's defense against Russia. The push coming as US aid continues to stall on Capitol Hill with a growing focus on Israel and the Middle East. Zelensky addressing a wider audience, but also having more direct conversations with Jamie Dimon, Ray Dalio, and Annmarie, Steve Schwarzman.
Well, he went up to Zelensky, Jamie Dimon, and said, "Hi, I'm Jamie Dimon. I'm the CEO of JP Morgan." Of course, Zelensky knows exactly who he is. Those conversations for Zelensky are just as important because he's trying to rebuild the Ukrainian economy. But the big topic today is happening in Washington, D.C. President Biden is hosting Speaker Johnson, and the main topic is going to be, you have to push this Ukraine aid through. And Johnson says, I cannot do that with my Republican caucus if you're not going to get on board with a border deal.
I love that where public sort of officials can't get things done, people look to the private officials to fill the gap. And I think you're seeing that on full display here. That on one hand, we're seeing all of this disagreement over whether you can pass aid in Washington or in Europe. And then he's just going to go straight to some of the richest people in the world, some of the top bankers, and say, can you guys help out? Because frankly, it doesn't matter where it comes from. And they would like some of the stability to really continue.
Just to talk about Ukraine just a little bit more, Ukraine's just not on the front page anymore, particularly after the events, the tragic events that took place in early October and the tragedies that have unfolded since then in the Middle East and in Gaza, they're just not on the front page like they were a year or so ago.
And how many articles have I been reading about who's to blame if Ukraine loses? What happens? Who sort of fills the gap? Does Russia start invading other countries? I mean, there are all sorts of theories that are being thrown out there. It still isn't getting the front pages, and that's even more so with Trump potentially becoming president once again.
Should we get to a lighter story and finish on
Please.
this one? Apple somehow surpassing Samsung as the world's top phone maker for 2023. Samsung losing the top spot for the first time since 2010. Apple's iPhone accounting for a fifth of the global market, but taking the top spot over all, despite a lukewarm reception to the iPhone 15 in China. I was surprised by this, Bramo, given the difficult year that the iPhone just had, particularly in China.
Well, this is the reason why I'm actually looking forward to. We're going to be speaking with Qualcomm CEO coming up, and the whole smartphone recession that we've been talking about has been hitting everyone. We've been focusing so much on the iPhone because of the Apple stock performance, if nothing else. But they are taking share. And this really goes to the heart of the question around their China role and whether really you can see any competitors push up the other way. And it also raises a question, can you diversify away from the iPhone if that's really the product that they're associated with most of all?
And of course, when you look at what Apple is doing in China, they're cutting their products by 5%. When you buy an iPhone in China, it's going to be 5% cheaper because they're so concerned with Huawei. So maybe at some point this also becomes an Apple Huawei in China, less so Samsung.
Haven't upgraded yet. Sticking with it. iPhone 12 for life.
Good luck with that.
For as long as the battery lasts.
Good luck with that.
It's a 12. For as long as the battery lasts.
You haven't cracked it?
We're sticking with it. No, it's still going. We're doing okay. I'm going to crack it now.
I was about to say, you're like this.
Let's kick off the conversation with Steve Cheverone, Head of Multi-Asset Solutions over at Federated Hermes. Great to catch up with you, Steve, as always. Steve, we're hearing a lot here in Davos about people pushing back against rate cut expectations. Are you on board with them?
Yeah, but look, we sat down, I think it was the first or second day of the year, and we said that 6 just isn't going to happen. I mean, at least not according to our view. You'd have to have material economic weakness to get 6. We've always said we thought that number was more like 1, 2, particularly because, and if people forgot, they got reminded this week, this is a presidential election year. And historically, the central bank does not like to move between July and November of an election year. So it really only leaves, in our mind, May, June, maybe December for cuts. And that's fine. And I think that's positive for the economy. But the market just got ahead of itself in the fourth quarter.
So what needs to reprice, Steve? I mean, this is sort of one of the questions that we keep hearing from people where they say stocks seem overvalued. But Steve Tananbaum of GoldenTree said credit seems fine to him. Do you agree?
Yeah, I think bonds are what really got ahead of themselves. If you think about the bond market, having rallied all the way from 5 to sub 4% yields at their low, and how tight credit spreads really kind of came in, it's the riskiest parts of the bond market that are the most expensive. Go over to equity land and it's the opposite, right? The cyclicals that were pricing in recession last year are still cheap relative to the broad market. The dividend payers that need lower rates are still cheap relative to the broad market. And then look at kind of high beta areas like small caps and even EM with the data out of China today. Those are as cheap as they've been in years. We think there's still relative value in pockets of the equity market, much more so than in the bond market.
Okay, so do you think that right now is a time to actually sell treasuries and buy stocks, buy even consumer cyclicals and things that are leveraged to the soft landing, but maybe not going to be as vulnerable to the non-rate cuts?
Well, that's how we're positioned. So we're neutral in cash in our portfolios, Lisa. We're underweight fixed income, and we are overweight stocks by the tune of about 5% for that reason. Now, right here at this point, with bonds, the kind of 10-year over 4%, we're neutral-ish. We expect you could see some more pain in the short run on yields moving higher, maybe towards that 4.5 level. But if you go out 12 months, once those rate cuts do start, even if they're modest, we think we'll see yields fall. So we kind of made that move, when we had a 3% 10-year yield. Right here, we'd be a little bit more neutral-ish on making a new move.
Steve, we spoke to Anne Walsh over at Guggenheim a little bit earlier on today, and she flagged the regional banking issues of last year and says they've not gone away. They're going to linger. That problem might return. Steve, where are you on the financials, and how do you feel about the smaller banks at the moment, given the bounce they've had over the last few months?
Yeah, well, before I answer that, John, just be aware your phone battery is going to start getting much shorter after your comments a few minutes ago. I just wanted to make sure you were clear on that one. No, look, I think our view on the economy is one that slows a little bit, but not one that weakens materially this year. Just like our view on inflation is one that eases but doesn't go in a straight line to 2%. That doesn't mean all the banks are out of the water here, but our view is that they're going to be okay. That the pressure on deposits has probably peaked. When rates fall, that should ease some. That there will be some credit stresses in the economy, particularly amongst lower quality borrowers, but not broad, not some kind of massive kind of credit deterioration or rapid rise in unemployment. So we think they'll be okay. And we're watching the financials closely because if you have a market that's marching to new highs led by financials, that looks a lot more healthy than a market that's marching to new highs led by your most defensive names. That's what's been happening since kind of October, November. We'll see if that continues over the next couple of months. But that's a key thing to watch in the coming months and weeks.
Steve, do you see good reason for that to continue in a world where you might get softer growth? I don't know to what extent. You might get lower rates. I don't know to what degree. But in that kind of world, where do I want to be in the equity market?
Yeah, John, my motto for the year is better is better. And I think when you look at where the rate cut expectations are coming from, or you look at where some of these names are priced, it's not one cohesive market view. There's folks that are in our camp that see a kind of just modest slowing, but still constructive background for the economy. And then you have folks that are pricing in recession. That's how you get to the 6 cuts. You're not getting there, I think, on folks that see a more modest view like us. And so I think what you're looking at in this market is one that on the headline level is pretty normal. It's 5% cash yields, down from 5.5% on a couple of cuts. It's bonds earning their coupon. It's equities growing with earnings. It's underneath the surface, though, where you see some real action. And again, it's those parts of the market that were priced for recession where rates being higher forever. Cyclicals, small caps, dividend payers. And yes, I think there's a point here where EM gets beat up so much that you just have to take a valuation flyer, and that's why we're modestly overweight there as well.
Steve, is this going to be an exciting year, or is it going to be a year of just sort of grinding it out and getting single-digit returns?
It depends on which parts of the market you're invested in. We think it is boring. So you've seen headline indices, kind of move 20 plus or 20% plus or minus over the last 5 years. We don't expect that. We think it's more like a kind of high single-digit, maybe low double-digit return at the index level. But again, underneath, look at those small caps. They're 30% off of their high from 2 years ago. They would need a 50% move just to get back to where they were 2 years ago. So we think it's exciting underneath the surface, but the surface level is going to look calmer than the turmoil underneath.
Tim Cook is listening. The battery's running low. Started in the last 15 minutes. I told you. Steve, I know. The conspiracy. Is it one? Steve Chevron at Federated Hermes. Steve, thank you. On Apple, on tech, the financials, and so much more. No drama, Lisa, seems to be the message from Steve. Take it. Don't make it worse than it is.
Stop being overdramatic. Just enjoy it. It is what it is. Even bonds, he's like, they might sell off. You might hold to 4.5% for the 10-year, but they'll come back down eventually. What's interesting to me is the small cap and the regional banks basically seeming to lean in based on how much they've sold off. That's interesting to me.
If you do get leadership from a different part of the equity market beyond big tech, I think most people would agree with Steve. That's good news. It speaks volumes about the economy. If you're getting leadership just from a narrow set of 7 companies, that's not a reflection of what's happening in the broader US economy, is it?
Which is exactly so, which is a reason why I think a lot of people are saying we've already seen a recession. It was a bad year in 2023, even though it looked like a great year. And this year you could see a recovery, even if on a headline level it doesn't seem quite as great.
Did you get the feeling people want to talk about Donald Trump yet?
Not
Davos,
yet.
Switzerland?
Not quite.
It's not happening, is it? It's not happening. Keep on asking. Keep on getting blank faces. What did we hear earlier this hour? It's the 4th week of the football season. Yeah, you guys want to talk about the Super Bowl. Well, of course we do.
Yeah, that's what happened. Because the Europeans are trying to prepare. They're running around panicked.
Without a doubt. Dave McKay, President and CEO at RBC, coming up next. This is Bloomberg.
Probability of soft landing in the US are increasing as time goes by. We do believe that inflation will get towards below 2.5% core PCE by the end of the year.
That was Dan Pinto, the JP Morgan Chase president and chief operating officer, on the outlook for inflation, and maybe a sprinkle of Fed policy views coming from Dan Pinto as well. Everyone's got a view. They may well likely start cutting interest rates at some point this year, probably not March, and ultimately 6 is too many cuts. The price action at the moment looks like this on the S&P 500. Lower yesterday. Again today, we're off on the S&P 500 by, let's call it, 1/3%. Yields just creeping a little bit higher, Lisa, up by a basis point, not even 4.1% today.
Really not a lot of drama. That's all I can say. There isn't a lot going on when it comes to economic indicators. You do get retail sales today. But really, some of these macro questions are not going to get resolved in a week. It's not going to get resolved in a month. So right now, it seems like people kind of trading sideways, adjusting around the edges.
Going to try and resolve some of those issues in 5 minutes right now with Dave McKay, President and CEO of RBC. Dave, good afternoon. It's good to see you.
It's good to see you in Davos.
Great to catch up with you, sir.
Yeah.
We've had some difficulties in banking in the last 12 months. We've seen it play out, particularly in the United States in the spring of last year. Some banks were in a position to go on the offence. JP Morgan won with First Republic. You've also gone on the offence. You've taken over the business of HSBC up in Canada. Let's start there. Tell me how that's going and why you seem to think you're operating from a position of strength and maybe even on the front foot in 24.
So our currency is very strong. We're incredibly excited about HSBC Canada. We received approval for it, regulatory approval, in December. We just announced that we're going to close the transaction at the end of March. It's a close and convert, so we can convert the entire client organization onto the RBC platform at the end of March. So we're very excited about that, and it continues the growth story for RBC. We have one of the strongest valuations of any bank in the world on a price-to-book ratio. We're one of the largest banks in the world from market cap. So that strength, that capital strength, allowed us to take advantage of HSBC's decision to leave Canada. Their 7th largest bank, roughly $80 billion in assets, 750,000 clients are all migrate over to RBC. But what they do really well is they're a fantastic global, internationally connected bank, cross-border bank, multi-currency accounts, trade finance capability, global view. And all that capability comes over to RBC, where we weren't as strong. And not only do we bring the clients over with that capability, we get to offer that trade finance, that global view capability to 15 million of our existing clients. Second thing it does for us is we take that franchise, we put it onto our tech stack, the RBC tech stack, and we are able to offer all the investments we've made in whether it's online banking, mobile banking, trade finance, treasury management, cash management. The HSBC clients will have access to a broader suite of product, a broader suite of capability, more channels to access. So from a client perspective, from an employee perspective, it's a big win. And from a shareholder perspective, it's incredibly accretive to RBC. We're a 14.5% CET1 ratio now. It's going to be roughly 240 basis points of capital. It's incredibly accretive to the organization. Boosts our ROE, which is around 16%. Significantly well into our target range. So it's accretive for the shareholder. It's good for clients. It's good for Canada. We'll pay more taxes in Canada. We'll pay more dividends to shareholders. And therefore, we're really excited about the growth story that this presents for RBC.
The two things you said there, Dave, that you repeated actually, trade finance, global view.
Yeah.
Here we are in Davos, Switzerland. How challenged is trade and taking a global view at the moment?
Trade will always exist. It's whether it's a regional view of trade, a lot of geopolitical commentary about supply routes, transit routes being challenged, obviously. And we'll figure that out over time as we think about our trade partners long term and we rebuild and rethink trading blocks. Trade will exist. And it may look different today and have some components of the world today and some components of the world tomorrow, but it's always going to exist. We have to, as a society, take advantage of our relative differences and our relative advantage. We have to keep inflation out of our economies, and global trade and global access to trade has allowed us to operate our economies much more efficiently. So we'll find a way. It just feels a little cloudy right now.
Literally. I am curious, as you talk about HSBC and this idea of integrating the Canada business, what's next? Who else are you going to acquire?
Well, we just acquired Brewin Dolphin in the UK 18 months ago. We're the 3rd largest wealth manager in the UK. We're the 6th largest wealth manager in the United States. And we're the #1 wealth manager both on distribution and asset management in Canada. So we're building, most people don't know, we're building this fantastic global wealth franchise. So when we think about acquisition and M&A, very much our global wealth franchise is part of that, whether it's in the United States or in Europe. We're thinking, how do we roll up more capabilities? Very fragmented in the UK, as you know. So there's opportunities there. So building out that global wealth distribution franchise predominantly is important to us over time. We'll generate significant excess capital, even more so with the HSBC acquisition, rebuilding our capability to do a cash transaction with our capital. So wealth management is a major focus for us.
What's interesting to me that you said was that it was not investment banking, that you are interested in further wealth management acquisition targets, but a lot of people are wondering what's going to happen to all these regional banks, and there needs to be some sort of roll-up, and you're not involved in any of that. That's what it sounds like. Why? Are you concerned about some of these banks?
We have a fantastic regional U.S. bank and City National Bank in California. It's a $75 billion bank by deposits. It's been a challenging year for regional banks, including City National, with deposit betas changing, with costs increasing from a profitability perspective. We missed our targets. We're rebuilding that performance over the coming year, and I expect us to reach our proper run rate by the end of the year, early into next year. But the regulatory environment's really uncertain in the U.S. The rules around liquidity, the rules around capital, the Basel III endgame has probably been a topic on this show all week. When those rules are resolved, and all we're looking for is a level playing field. Canada's already moved more aggressively to a Basel III endgame, so we're looking, are we pulling up to where we are? Are we coming down to where other global players and other global economies? So that certainty is really important when you evaluate an organization and understand the deposit flows and where they're going. The deposit story in the United States is still challenged as well. So I think I would need more clarity on those outcomes before I could really value a U.S. franchise right now.
So are you interested in expanding in the U.S. at all right now, or is it not really the most fruitful place? Is it other places in wealth management that are more fragmented that you see a greater opportunity?
We have significant opportunities to grow in the U.S. on an organic basis, whether it's the ninth largest capital markets business in the United States. We're seeing greater ECM activity, DCM activity. The rate environment's becoming more constructive for that business. So growing our capital markets operation by bringing in teams, expanding our sector coverage. We're doing well there. We're hiring teams and lifting out teams in the U.S. wealth franchise. We have $550 billion of AUA. We're the sixth largest franchise, national franchise in every market. So again, organic growth. We brought in $25 billion in AUA last year alone, largely through team lift-outs and new clients coming in, and growing the City National franchise at the same time, which is a real focus on the entertainment business in California, selectively growing that business. So we see significant opportunity across those three franchises. We have $4 billion in revenue in capital markets and $1 billion in profit. We have a $500 million P&L in our wealth franchise, and we have another opportunity to do something similar in City National. So growing those franchises is really our core focus right now. But once we digest HSBC and we rebuild that capital base, then we'll
You'll come first and tell us.
We'll come first to tell you, exactly, yeah.
Dave, I want to finish on housing. I have to say, I'll speak for Lisa and me.
Yeah.
When rates went from 0 to 5, when we saw rate hiking cycles in places like Canada, the UK, and even Australia, we were both thinking about what on earth is going to happen to housing markets? Right. Where does that leave the banks? I was thinking about that with regards to Canada as well. What is happening?
So there has been a payment shock to Canadians, and the difference between Canada and the U.S. is we don't have a 30-year fixed mortgage. We usually have 4 or 5-year terms. So we have a lot of variable rate mortgages at the same time. 20% of our book roughly is variable rate mortgage. So you've seen a payment shock to about 30% of Canadians right now, in the tune of 20 to 25% increase a month, $400 or $500 a month increase. So that's been challenging for Canadians. What it does is it slows the economy much more quickly. Unlike the U.S., where there is no payment shock really unless you break your mortgage or sell your house. So the U.S. economy struggled to slow the consumer. The Canadian economy has slowed the consumer quite significantly, and we've seen that in the credit card business. People have a mortgage, people have a variable rate mortgage, credit card spend is off. Canadians are handling that payment shock well, so you're not seeing that migrate to default, but you're seeing the Canadian economy slow much more quickly, to the point that we already have a quarter of negative GDP under our belt. We're looking at probably another negative quarter of GDP. We'll technically be in a soft landing recession early this year. So Canada's slowing more quickly. Inflation's still a little bit sticky, around just above 3%, but there's still 70% of that book is going to reprice over the next 2 to 3 years, and 15% this year, 25% next year. So unless we get rates down, there's more payment shock coming, but consumers are handling it.
That's one to watch. Dave, it's good to see you.
Yeah, it's great to see you. Thank you for inviting me.
Yeah. Dave McKay of the Royal Bank of Canada, live from Davos, Switzerland. This is Bloomberg.
Geopolitical tensions are on the rise. We are seeing signs of fragmentation.
When we have an escalation of these geopolitical risks and the deterioration of the geopolitical situation, that could have a very negative impact on the global economy.
The tensions that are carrying over from last year are still there. Obviously, the war in the Middle East is a big preoccupation, and concerns that will spread, although it seems manageable so far.
We're in Cold War II. Could get to be a hotter Cold War II than it was. And that's very destabilizing.
Markets do a poor job of pricing in geopolitical risk until the triggering event occurs.
This is Bloomberg Surveillance, live from the World Economic Forum in Davos.
Live from Davos, Switzerland, for our audience worldwide. Good afternoon, good afternoon. This is Bloomberg Surveillance on day 2 of the World Economic Forum, alongside Lisa Abramowicz. I'm Jonathan Ferro, together for the week with Annmarie Hordern. Topic of conversation number 1 on the agenda. I said it in the last hour. If you have an American accent, you will be asked about this man, Donald Trump.
The Trump election, the first, we all looked around and thought about putting in hedges.
I mean, I hate to predict anything he's going to do because the whole problem is he's completely unpredictable. But, there's no appetite for that.
When we look at the likely policies, there may be some serious concerns.
It's, of course, a great concern. We've been there before. We survived it.
We are all concerned about it because the United States is the largest economy, but we have to be extremely attentive and anticipate, just as we do with inflation.
This has absolutely dominated conversations now for the last 2 hours on this programme and the last 2 days at this forum. Lisa, that question's not going away anytime soon. That question, that conversation, behind closed doors, off the record, lively. When you start to ask people on panels at the World Economic Forum or in conversations in this studio at this set, they don't want to talk about it too much.
They don't want to talk about it. I don't know exactly how much fear there is if you're not necessarily a global player that's looking for cooperation with the United States. From a business perspective, it seems like people are taking it more in stride. When it comes to just general uncertainty, not so much. And when it comes to international partners, a whole lot of concern about a real lack of cooperation.
And part of that is because they haven't prepared. They had 4 years to prepare for potential Trump's return. They know what the playbook and what his policies are, and he's not shy about advocating for them right now. If he is to be reelected, there's a good sense of what he plans to do.
This hour, just an absolutely fantastic lineup, Lisa. We need to talk about it. We'll catch up with the Dutch Prime Minister, Mark Rutte of the Netherlands. We'll also be speaking to the Foreign Secretary, Mr. David Cameron. Really difficult time with 2 wars ongoing right now, one in Ukraine and another in Gaza.
Yeah, and we're also later going to be speaking with Qualcomm CEO about the business environment in a very split world. But right now we're going to be speaking with the Bank of Israel governor, which to me is a fascinating position at a time of such conflict, at a time where it's so hard to really piece out where the income is going to be coming from in an economy that's mired in war.
Let's start that conversation with Amir, Yaron, the Bank of Israel governor. Governor, good afternoon.
Good afternoon.
It's good to see you. It's a delicate situation that you're in, so let's talk about it a little bit. Early October, your world changed. Can you tell me what it's like now, what's changed for you as a governor overseeing a wartime economy?
First of all, when the war started, the first thing we focused on was financial stability. And indeed, we put up a $30 billion selling of reserves, a $15 billion of swap, making sure the markets function. We all know what happens when market starts being in a negative dynamics. And indeed, we achieved that. The markets settled down after the shekel did depreciate, but there was enough confidence. There was some stabilization vis-a-vis the north, and the shekel actually went from 386 all the way down to 3.6. It's now at 3.79, but other markets function as well. We were primarily focused on that, and that's why we didn't touch the interest rates, and we made that message very clear. We lowered interest rate in our last meetings, because we felt the markets have stabilized and we saw inflation decelerating. Indeed, we just saw the CPI. Our target is between 1% and 3%, and it just happened to land on 3%. And so we lowered the rate. It's still restrictive, but we think that was necessary and needed given where we were, given a war, given all the financing. But going forward, as the committee said, it's going to be very cautious, very moderate, depending on how further inflation decelerate and how economic activity and the whole uncertainty around the world develops.
This is obviously a shock across several dimensions, but just to sit on inflation just for a little bit, you talked about the FX channel there. I'm with you. I think we all were. In the immediate aftermath, we're thinking about whether this would develop into an inflationary shock for the economy. What are your thoughts now on the trajectory for inflation? What's the outlook look like?
I think initially we saw the negative demand shock outweighed the negative supply shock, which is primarily in the construction industry, where about a third of the industry is from the West Bank and they're not in. That could affect inflation down the road in a half a year from now, where, prices might come back up, and then rentals, some in agriculture. But overall, the negative demand shock overweighed, and indeed, it put inflation into the target faster than we initially anticipated. Prior to the war, we were on a path of a super softish landing. We were growing at 3.4% in 23. Probably slightly above 3 in 24, and inflation was going to come down into the target anyway. Now we anticipate a 2% growth in 23 and 24. If everything is according to our scenario, which is basically military, primarily focused in the South, intensities will go down somewhere around the first quarter. In that scenario, it's that 2%, and then resuming back to Israel, potential growth of around 4-5% in 25. That's in terms of growth. The big challenge is the fiscal side. The fiscal, the war is costing us directly, and this is give or take about 10% of GDP and another 2% in sort of lost revenue. I call that the temporary hump of the war. The real, and we can. Growth will take care of that in terms of what it will do to debt to GDP. The other side is the permanent component increase in spending on military, in the more expensive debt, and the revitalization of the South. That's about another 1%, and we were able to compress it, at least for now, for 1%. And what I want to point out is this week there was a new national budget, and the government went through, in a pretty short time, through making significant steps to offset that 1% increase. And that puts us probably on a trajectory of stabilizing debt to GDP at around 66, 67% in the next coming years.
We talked to a lot of officials, the Federal Reserve, ECB, and they talk about economic projections, and we talk about the varying degrees of angst around trying to hike rates into a recession if you see inflation picking up, or cutting rates at a time where inflation's not coming down. You have a uniquely difficult situation. How much certainty do you have around economic projections that are made at a time where there's still hundreds of thousands of people serving and are not able to fill their jobs, where you have tourists who are not coming to Israel and we don't know when they're going to come back? All of these types of existential questions hanging over that outlook.
So the scenario that I outlay and the numbers that I've given are obviously around an analysis and of a model, and these models have usually large uncertainty around them. Now expand that by a mile, and of course, if there is a north border event, that that means the numbers are very, very different. But you have to basically analyze. We know what's going on in terms of the different segments of the market. We saw actually huge recovery towards November. For example, credit card usage dropped to about 70% when the war started. It's over 100% right now. We saw once missile stops and, many families were in the house and the education system was not on. That meant many people were not working. That has come back.
I am wondering, when you look at all the cross-country flows, how much flows from other Middle Eastern countries have resumed at a time when there's a real fear of a widening out in the war? Is there still the same kind of international commerce that can feed the economy in a supportive way?
So I would say, first of all, as you know, the high-tech sector in Israel is very, very important for our economy. You know, the companies obviously are still working. You said obviously there are some workers that are in reserve, but generally they're working. I think the big issue is going forward not to lose a cohort of new young seeds, the ones that are well known and have revenues will continue to do that. And, you know, hopefully the new relationships that we're just beginning to establish, whether it's with the UAE, et cetera, those will continue. And, you know, the challenge will be to bring a day after in which there is a mechanism, there is security to Israel, security to people in Gaza, that actually, and some prosperity there. And, you know, that is obviously a challenge. It's not really in my hands. But I think if you look at Israel's, you know, talent, it's there. In terms of the high tech, there's a lot of demand for, you know, home security economics now. And so I'm pretty confident those things that we're monitoring will be there. Obviously, this is a big shock, and we are continuously monitoring all these developments, as you say, segment by segments, and all this analysis is predicated on the best information we have right now.
It is a big shock, and you're a wartime central banker. How are you planning for the impact or potentially your response if this was to expand, either to the northern border or potentially even more skirmishes outside the Red Sea and et cetera?
So as I mentioned, we first took our main course of action was to make sure there's financial stability. Once that settled down, we went back to the interest rate tool, and even there I said it's going to be moderate. It's going to be cautious. It's going to be partly a function of inflation, economic activity, and further developments even on the fiscal side, and of course on the geopolitical side. If things develop, we will need to readjust our assessment and maybe go back into a mode of, you know, focusing more on the financial stability.
Do you feel like you're constrained to some extent if this war did spread and it increase the shock to the Israeli economy? Do you feel like you are constrained to your ability to reduce interest rates from here?
I think either way, the process would have probably been a slow process. Yep. I don't think interest rate, not just in Israel, I think around the globe, when this cycle is over, they will be in a higher zone than they were before. So the path here is not going to be at a rate of hikes that we did upward. It's going to be slow. It's going to be moderate. And it's probably going to stabilize at a higher real interest rates, and which means also somewhat higher nominal interest rates. So I don't think we are constrained, except the fact that we are going to be cautious anyway, and we are going to be on the lookout for any financial issues and developments that we look. And as I mentioned, we don't often mention fiscal policy in our forward guidance, but we did. And as I mentioned, I think there were significant steps at least to offset the permanent component, which means our debt to GDP should stabilize and not diverge. And I view that as a very important statement to the markets.
Governor, we appreciate your time today.
Thank you very much
for being with us. Thank you, sir. Amir, Yaron there, the Governor of the Bank of Israel. Coming up shortly on this programme, Chuck Robbins, the Chair and CEO of Cisco. From Davos, Switzerland, this is Bloomberg.
Ever since we started this journey of bringing the U.S. chips and the EU Chips Act to place, it was all about building resilient supply chains. Everything digital runs on semiconductors, and through COVID, we saw the fragility of our supply chains. Because of that, we said we need a balanced supply chain for the world. And that's what we're off to do, is to rebuild the Americas and the European supply chain for semiconductors. So, hey, we're all better off, right?
Pat Gelsinger, the Intel CEO. You bump into some folks here at Davos, Switzerland that are just consistently upbeat, regardless of the time of the morning. Pat Gelsinger's one of those, isn't he?
He was incredibly upbeat. I was just curious whether his scarf was a QR code. And
I thought the same thing.
So I actually tried it. I took my phone and I tried it. It was not a QR code.
No, but he did say he was going to try and transform it into one. Or something like that.
Something to work on. Artificial intelligence.
We'll move on from that. Don't worry about that. Let's turn to the price action just briefly. Yesterday, a down day on the S&P 500. Today, a down morning so far in New York. Equity futures negative by 0.4%. Yields climbing just a little bit higher by a couple of basis points, 4.08%. At the turn of the year, it was all about rate cut talk. Can we start in March? Can we deliver 6? The pushback over the last couple of days has been overwhelming.
Yeah, although Steve Chiavarone put it well to me. It's not a matter of people betting on 6 rate cuts. It's people betting on both a soft landing where you don't get as many rate cuts and a recession where you get a lot more rate cuts. And that's sort of the divergence that you're seeing expressed in 6 rate cuts. What we've heard here is a whole lot of optimism. And I think that's the reason why the not as many rate cuts is really the story that gets the greatest attention.
Well, let's talk about whether that optimism is backed up by the facts, the outlook for global growth and what it means for Cisco. Chuck Robbins, the chair and CEO of Cisco, joins us right now. Chuck, good afternoon.
Hello, how are you?
Good to see you, buddy. Great to
to
catch
see you
up,
guys.
as always. Let's get straight into it. Engines for growth. Ken Rogoff of Harvard sat in your chair at the start of the week, and he said he's not sure where growth is going to come from. That's an economist. You're running a business. Where's the growth coming from?
That's the difference between someone who runs a business, right, and an economist. We've talked about AI all week long. Yep. It's a big opportunity for us, and I think that you'll just continue to see new opportunities emerge, things we don't even understand yet, applications that we haven't seen that are going to take advantage of what's going on in AI over the next 6, 12, 18, 24 months. Cybersecurity is an incredible area of investment for our customers, particularly as generative AI helps the bad people be worse people and make them better at what they do. And we have to really come together as an industry and work hard to protect our customers. So cybersecurity is a big one. I think all of our customers continue down this journey of thinking through how their applications are architected and where they reside. Are they in the cloud? Are they in the private cloud, public cloud? Which public cloud? Or am I consuming them as a SaaS application? And hybrid work is still in place. So there's still a lot of positive out there.
How many years have you been coming to Davos?
This is my 11th.
Okay, so it's been 11 years. Yeah. This Davos feels a little bit different, like people are actually just trying to get a lot of deals done and try to figure out exactly what to lock in. Do you get that feeling too?
Well, I think somebody asked me earlier about whether this felt like a normal Davos, and I think it seems busier, first of all, this year. And I do think there's a lot more tangible business discussion, I think, going on than you might see normally. But there's also a lot more to talk about with all the complexity going on. You've got elections, you've got the Middle East situation, you've got Ukraine, you've got are we going to cut rates? You've got AI. I mean, it just goes on and on and on and on. There's just so much to talk about.
What's going to affect your business most? I mean, are you expanding more in certain regions to avoid some of the conflicts that you keep seeing? Or are you basically just sort of keeping an eye on all of this and then chugging forward with continuing to try to hire the best cybersecurity people and move forward with all of the different programs that you've been working on?
Yeah, I would say that we're investing in areas where we do see growth. We're investing a lot in AI. We're investing in cybersecurity, the same areas that I talked about earlier.
In which regions?
In which regions? It's pretty. I'd say it's pretty well balanced. The AI specialists tend to get hired where we have engineering hubs, so that's first and foremost. But we've also, because of what we saw in the pandemic, I think every company's been diversifying geographically relative to their supply chains, so that, as we've talked about before, no one ever designed a supply chain expecting an entire country to shut down. So we had to make some changes to that, and we continue to work through those kinds of things.
You've been going through a big transition for quite a while, going towards software, towards recurring revenue. We've been talking about this for years together.
We have.
Is that transition complete now? Are you comfortable with where you're at?
We've made a ton of progress. When we get the Splunk acquisition completed, we'll surpassed $20 billion in software sales as a company, which puts us somewhere in the top 6, 7, I don't know, something like that. So, but there's still more to do. There's still more software assets we can build organically, probably some inorganic stuff we can do. But at the same time, with the AI explosion, we're a significant recipient of the infrastructure benefit underneath the GPUs in both the web scale as well as ultimately in the enterprise. So our hardware business, which in some cases has subscriptions associated with it, in some cases do not, we think that both of them can grow over the next few years.
This is a tough question to answer, but do you think investors have fully internalized your view on where things are going and your message?
I think they've internalized the message. I think they're just looking for, one of the things that we've talked about is that this transition to software should give us more predictability and less volatility. And we've seen that come into play, but we still probably have a little bit too much. And so we've been rewarded for what we've accomplished. And I think as we continue to do that and we continue to deliver, you'll see that in the future.
You know, from being here for a couple of days, everyone wants to be a part of the AI story. What surprised us, and I'll speak for myself, what surprised me last year is how quickly it became real. It wasn't just a story that companies were selling, it was something they were monetizing, and the growth was exponential in some cases. Yeah. NVIDIA, a great example of that. Can you walk us through on where you're seeing actual real tangible growth right now off the back of what's developing? Yeah,
I've actually told my team you're not allowed to espouse about AI unless you follow it with a tangible way that we're implementing whatever you were talking about, because there's so much noise in the system. Look, I think if we're building the infrastructure that's going to support underpinning all the AI networks. So that's happening today. We're running pilots right now with web scale players. We're working on a lot of design around future integrated stacks that we're going to take to the enterprise to help them do it. Secondly, we're looking at how we can deliver a better customer experience for our customers by leveraging Gen AI, which every company is or should be doing. We're building security assistance, as an example, to help customers navigate all the security tools you have and actually make sense of a lot of it more rapidly. We're doing the same in collaboration. We're transcribing meetings, and so there's a lot of stuff that's going on right now. But I do think some of the greatest applications, we have no idea what they are yet.
Which is something definitely that's been a theme.
This thing is early. It's super early.
One thing that's early maybe is that HPE is coming for you more aggressively. They bought Juniper Networks last week, and they said that they're going to be able to compete more directly with you. So what's your response?
We love good competition.
What's your way? What's your way of gaining some of the market share in a highly competitive market?
Look, I think that we have competed with both HPE and Juniper in the past, so I don't know that it changes a lot for how we think about competing with them, to be honest.
Chuck, it's good to see you.
Good to see you.
Great to catch up. Thanks. Diplomatic. Very careful about answering that question.
Yeah, I didn't say.
Chuck Robbins, the Cisco CEO, on AI and the real tangible areas of growth we're actually seeing in businesses. To try and I think Chuck's right, to try and draw a line between the noise, which is everyone's just trying to say AI, and like I'm a part of that story, and the actual tangible things that are happening, materializing in front of our eyes. Two important things to look at.
Especially not only on the benefits, but also the risks. And I do feel that in some of the conversations. And we're not just talking about misinformation, but I was struck by this one line that we've heard repeatedly. I know that you've heard it, I've heard it as well. Financial disruption in new types of ways that really could become problematic that people aren't really thinking about. These are some of the things that people are trying to hash out in much more real terms here.
Confronting an era of misinformation, maybe. Never mind the good things we might do with this new technology. I think there's a big focus here as well on some of the bad things. In the next 30 minutes, absolute must-watch television. Mark Rutte, the Prime Minister of the Netherlands, and David Cameron, the Foreign Secretary of the United Kingdom, all coming up in the next 30 minutes. This is Bloomberg. Economic data in America just seconds away. Going into it, the scores look like this on the S&P 500 and in the bond market. Equity futures negative by 0.44%. Yields are higher by a single basis point at 4.07%. As we wait for retail sales to break and the conversation continues over how many rate cuts we'll get in 2024. With the economic data, let's get to Mike McKay. Good morning, Mike.
Good morning, guys. We are looking at a good month for retail sales, it appears. I'll get the breakdown in just a second, but right now we see headline retail sales up 0.6%. I'll be waiting for the revisions to that. Retail sales always heavily revised. Ex-autos up 0.4%, and ex-autos and gas up 0.6, which is good because we know gas prices fell, so that's still a lot. The retail sales control group, which is what goes into GDP, up 0.8. That after an initially reported 0.4 in the month of November, so that is double what was what we saw last month, and it's 4 times what was expected. Quickly looking at import prices, they were flat on the month after a decline in November, and ex-petroleum flat on the month. So no inflation pressures coming in from those. And one other data point I want to give you before we get to the breakdowns of this stuff is mortgage applications. We haven't paid a lot of attention to that for quite some time for obvious reasons. They were up 10.4% last week after 9.9% the week before. So we've seen a little backup in rates, and we're seeing some results in the mortgage market.
Mike McKay, we're seeing some moves in financial markets, so let's round them up. Let's go through equities, bonds and foreign exchange. March rate cut. What March rate cut? And I think we said this after the payrolls report a few Fridays ago. So let's look at the equity market first together. Equity futures near session lows on the S&P 500, pulling back. In the bond market, yields are higher, much higher. If you break up the yield curve, 2-year, 10-year, 30-year, go to the policy-sensitive front end of the yield curve, up 14 basis points on the 2-year off the back of that hotter-than-expected retail sales print. 436 on 2s, on 10s, 411. In foreign exchange, dollar stronger, euro weaker, 108.56 off the back of this. Lisa, that data endorsing Governor Waller's view of the world in the past day or so.
The strength is not going to allow them to cut rates as quickly as people are pricing in, and I think that that's what this data seems to suggest, and that seems to be what the market is hearing, albeit on the margins. Right now we are seeing still a 58% chance of a Fed rate cut in March, but it is coming down, edging lower as we go through this.
And Mike McKay, you've had a few extra seconds to chew over the number. Do they look as good as they look on the surface?
They do. All those pretty coats you guys are wearing in Davos, I know you picked up probably in December. Clothing and clothing accessory stores were up 1.5%. That's the leader during the month. So you did your part for the U.S. economy. Gasoline stations down 1.3%. No surprise there. Gasoline prices continue to fall and take away from inflation. We saw motor vehicles up 1.1%, but even without the motor vehicle component, retail sales were strong. Food services up 0.6, so that is also good. Building materials up 0.4. I keep saying also good. Pretty much all of these are good except for health and personal care stores down 1.4%. Department stores were up 3%. That is a strong number after there were expectations that maybe people weren't buying as many goods at the holiday time. Non-store retailers, your Amazons, etc., up 1.5%. But food service and drinking places were flat on the month. No increase there. So I'm not sure. Maybe you guys bought coats instead of drinks during the month.
Mike, I just want to finish up because we were talking about what are the most important indicators to really be watching. Was it the jobless claims that are going to be the sort of leading light, or is it going to be some of these retail sales, the consumer continuing to spend? Do you hear more economists paying more attention to indicators like this that are coming in much stronger than many people expected?
Well, there's been a lot of talk about whether the economy is slowing down or picking up, and this fits into the picking up camp. And so we'll see whether that starts to get incorporated in people's views of GDP for the quarter and for the future. We should get an Atlanta Fed GDP Now number out reasonably soon this morning, and it should go up. I want to point out that the Retail Sales Control Group I had said was up 0.4 in November. The revision is up 0.5. So even stronger sales in November and strong sales in December give everybody something to look at. Now, yesterday, Chris Waller made a lot of news by saying that 6 rate cuts were ridiculous, and this is kind of supporting that view at this point. The Fed is not going to be cutting rates if the economy is this strong. So we'll see next week when we get the PCE numbers. They'll add in services to these good spending numbers. We'll see how overall strong the U.S. consumer is.
Mike McKay, thank you, sir. Mike McKay on a hot retail sales report. Let's turn to the price action again, Lisa. We'll go to 3 boards and work through it together. Equities going into the opening bell about 55 minutes from now. Equities pulling back off the back of better than expected retail sales. Equity futures negative by 0.5% on the S&P 500. We can turn to the bond market. Yields are higher on a 10-year by 4 basis points, 4.1% on a 10-year. On a 2-year at the moment, higher by a lot more than that. Double digits, up by 11 basis points, Bramo. Your 2-year, 4.33.
And this just sort of confirms the steady grind that we've seen as we get better than expected data and as growth is surprised to the upside. If we get a true belief in soft landing, that probably also means a true belief that we're not going to get the rate cuts that we're going to expect. But is this inflationary? And that was something that Mike has talked about. When can we stop thinking about immaculate disinflation if we start to see some of the inflationary inputs pick up as well?
Really pleased to say, Lisa, we can continue the conversation here in Davos, Switzerland. Cristiano Amon, the CEO of Qualcomm, joins us around the table. Cristiano, how are you, sir?
Very good.
Good to catch up with you. Let's start here with the business. I want to get straight to it. The smartphone business. What's happening with Apple over the last 12 months? Their core piece of hardware seems to have gone ex-growth. Have we reached that point of saturation for smartphone sales, do you think?
Well, that's a good question. Maybe I'll take a step back. You know, the phone market is a big market, but, you know, it's a fully penetrated market. And I think we go into cycles. I think we did see in 2023, particularly correction. I think we have, to the pandemic, we had a lot of demand. But, you know, we had some last earnings call. I think the market is returning to stability. We're cautiously optimistic. So I think we have the normal rate of the market, which is a replacement rate market. But this Gen AI transition could create a new upgrade cycle, and then all of a sudden we have a lot of growth again, and we'll see.
Let's put some sort of some tangibles around this. When do you see the smartphone market returning to growth? How long will it be before we get there?
It's very hard to make a prediction, especially because you know, you look at the market today, and you know, the market used to be much bigger, even when you think about prior to the pandemic. We're not calling the market number just yet in 2024, but we know it's smaller than it was to be. I think people looking at the current macroeconomic environment, they kind of decide when they're going to buy a new phone. However, the growth vector, it's really related to new functionality that it's going to compel you to buy a new phone. And we just, like, today or tomorrow, I think Samsung is launching an Impact, a new device, going to talking about Galaxy S24, some of the things you can do with Gen AI on the phone. And as we get to the transition, I hope everybody wants to buy a new phone. We're going to have growth again.
And we'll be able to just go like this, and the person that we want to see is right going to be over there. I'm curious, from your point of view, how concerned you are about, say, Apple creating its own chips, creating its own hardware. And we've seen this, and they basically had some issues with it. They prolonged their replacement chips. But how much does that worry you?
Well, look, Apple has always had their own processor on the iPhones. I think our relationship with Apple is on the modem. We provide to them the chips to make their cell phone connect with the cellular waves and make sure you're connected. That's our job. They have been focused on trying to develop their own chip, but recently we just renew our agreement with them. I think we have a new agreement with them. It covers out to 26. And we'll see. I think right now we're just focused on being a good supplier for the next 3 years, and I'm going to give you my same answer. As long as cellular remains important, I think there's going to be a role for Qualcomm.
You've been pretty safe when it comes to some of the tit-for-tat between Beijing and Washington, but how are you looking at navigating that going forward, given what we've seen other companies deal with?
Look, we've been fortunate that some of the things what we do today, we're not in the data center, we have not been impacted by any of the restrictions. And in one way, as the peak of tensions, I think, between the two countries, I would say that our business actually with China actually increased as we diversify our company not only into phones but into PCs and cars and industrial, we expanded our relationships with China. Here's my simple answer, I think, to that question. Any company that has a leading technology product and is a product that becomes very important for the digital transformation of many industries, such as automotive and others, you're going to have a big business in China. It's just a function of GDP. I think we have been so far in a stable place. We have to monitor the situation like every other company. And, I will continue to believe, and that's what I had said, at the end of the day, strong commercial relationships between American enterprises and our Chinese counterparts will be one of the things that could bring stability to the relationship.
Does that monitoring get more challenging if we were to see a former President Trump win back the White House next year?
Look, we're just focused on our technology, and we want to have markets that we can sell our technology. I think at the end of the day, one important thing to understand is certain technologies are globally interconnected. So you're going to have customers in different locations. You have customers in Europe and Japan. They will have a business in China as well, and you want to be a global supplier to them.
I can see the Qualcomm team just around the corner, very happy with that response, that you didn't take the bait and talk about the former president. Cristiano, I want to talk about the direction of travel in the global economy. For a chip maker, just for the industry, do you think we're close to the point where they have to pick a country, have to choose a side? We're either going to supply China or we're supplying Europe and America. How close are we to that moment?
Look, I don't think we are right now at this point in the industries that we serve. And it's one of those things that, if it changes, I think companies have to adapt. We have seen that some industries had to face that. You have some industries that's kind of the reality for different reasons, whether it's a cloud company or a social media company, and et cetera. We have been not at this pace, so it's something that we're going to have to worry about it in the future.
What industry do you think is going to be the biggest area of growth for you?
We are very pleased what's happening with automotive. We're now working with virtually every car company. The car is becoming a new computing space, and our job is to provide the digital part, and I think sometimes they go alongside electrification. That's exciting. It's going to build revenue for Qualcomm over time. The other one that was really happy about it, and it's new to us, we're entering the PC space. We just built now the fastest processor for any laptop, and we think that could be a great opportunity for us.
Okay, I have to ask this as we step back and sort of reflect on this AI-infused Davos. Are we even going to have laptops, or are they basically going to be headsets that we put on and we go like this and our words kind of show up? I mean, how far are we going away from the previous models of normal existence?
Look, it's interesting. It's a great question. I remember when laptops appear, people thought that the desktop will go away, and then when phones appear, people said the computer is going to go away.
Yeah.
And when glasses appear, you think the phone's going to go away. I think the reality is your phone's going to be still with you. Your laptop's going to be still with you, but they're going to become much better, and they're going to become more useful, and you're going to get more out of them. And I think that's going to be the great opportunity of Gen AI in those devices.
Cristiano, appreciate the answer. Thank you, sir.
Thank you. Happy to be here.
It's good to see you. Cristiano, I'm on there, the Qualcomm CEO. What's this? Words come up when you do this?
Yeah.
What's that?
I mean, don't you see people wearing headsets and they go like this and they can...
Oh, they sort of get lost because they've got the virtual reality headset on.
I'm excited to see what they can do.
Now, I understand. I just didn't know what...
$4,000
headset
that Apple's launching. Well, it could be the future, and maybe it'll cook dinner.
Serious face. Coming up on the programme, next guest, Malhotra, the Prime Minister of the Netherlands. That conversation just around the corner, shortly after this commercial break. Just to touch base on the price action following a better-than-expected retail sales report out of the United States. Equity futures on the S&P 500 negative here by 0.55%. In the bond market, we look like this: 2-year, 10-year, 30-year. The 2-year yield is a bit higher off the back of that story. Bramo up 10 basis points on a 2-year, up 4 on a 10-year.
So we had talked about the potential loss of some sort of volatility. It seems to be coming back just a bit. I will say there does seem to be a feeling in the soft landing. One key question is how much has been priced in. Steve Tananbaum of GoldenTree Asset Management was saying he thinks about half of it has been walked back. There's another half that still has to go.
You know, for special guests, we don't take commercial breaks, and one of those special guests, a good friend of ours, Mark Rutte, the Prime Minister of the Netherlands. He's jumped into the chair. Prime Minister, it's good to see you again.
Good to be here.
It's fantastic to catch up. We've got a lot to talk about.
What a Davos it is.
Is that what it is?
Yeah.
I won't try and repeat that, OK? Prime Minister, you're in a different position now. I've caught up with you over the years at this forum several times. You're now overseeing a caretaker government. We can talk about your future down the road in just a moment. There's a big, big focus on Geert Wilders at the moment. Can you talk to me about that man and help our audience understand who he is, the man that you've known for a long, long time, and what we should all know about?
Well, I'm not sure that's up to me, because you could interview him, and I think he would love to do that.
I don't see him here.
No, the point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration. And clearly, he got the upper hand in the election result. Now, we are famous for having to form coalitions. It takes a long time to do that. So that could still take another couple of months. So we have to see how long that takes. In the meantime, I'm there. But I'm absolutely convinced that on the fundamentals, our outlook to the rest of the world, support for Ukraine, membership of the EU, nothing will change.
You don't think these political changes are a threat to the European project?
No, I don't think so. Because for the Netherlands, yes, we want a strong nation state, but we also need, as one of the biggest exporting countries in the world, we need that membership of the internal market, NATO, the UN, because our safety, both in the economic sense, but also in a literal sense now that Ukraine at this moment is being attacked by Russia, is crucial.
Let's get to NATO. ECB president, odd character in her position to be commenting on the former president, but has commented on the former president, Donald Trump, said that Donald Trump was a threat to some European interests, including NATO. I'd like to talk about NATO with you. We all would. It's interesting to me how the Europeans constantly frame this as America not helping us, the former president not helping us. Can you help us all understand how European countries and governments have been helping themselves? What's happened with defence spending in the last 4 years? Have they put NATO in a better place?
And this was exactly Trump's main issue, that we were not spending enough. And he was right. He was right, because America is about 50% of NATO economy. They were at that moment, when he was president, spending about 75% of the NATO budget. And the rest of NATO was only doing 25%. So he was completely right in forcing us to live up to the 2% commitment. So we invested another 5 billion, which brought us to the 20 billion, which is almost 2%. We are still not exactly there, but almost. And many other countries have done the same. So I always thought that he had a genuine argument here. And by the way, for the US, to be in NATO is also in their strategic direct interest. If Russia would gain access to this part of the world, it would also be a threat for the US. So NATO is not just a project from history, never repeat the mistakes of the Second World War. It is also about security now, today, also for the US.
And this is why you've told your colleagues when Trump was president that you shouldn't criticize him. He is right when it comes to some of these multilateral, multinational organizations that more should be done. We need to look inside. No. But you're potentially going to be working with him again if you get the top job as Secretary General of NATO, which rumor mill has it that it's going to you, and Trump was to come back. How would you handle him? Because people say to me that you were a Trump whisperer of sorts.
No, no, what I always said is we have not voted in the US. I'm a Dutch citizen. I cannot vote in the United States. So we have to dance with whoever is on the dance floor. And in the end, for the whole of NATO territory, it is crucial that you have amicable personal relations with the other people. And in the end, in the US, it is not only the president making all the policies. There's also the very forceful and powerful Senate Foreign Relations Committee. The House is involved. And there is a strong transatlantic tradition in the US. And I always felt again that Trump was right on this issue of paying up to our commitments.
But is that also confirmation that you are taking that job at NATO?
I'm not commenting because I said something about it in October and I've decided to end it there. So,
but it will be in the next few months. I mean, and NATO's celebrating their 75th anniversary. It's a big year.
Yes, this is a big year for NATO because in the Washington summit is the 75-year summit where Jens Stoltenberg will preside as NATO Secretary General. No, I said something about my own future in October and I leave it there and I'm not going to add to what I said at that moment.
Although I would like to just sort of build on this idea that Trump has been front and center at this conference. What do you think people have wrong when they talk about some of their fears? Because we've heard this again and again, that a lot of people are very concerned about Trump 2.0. And you don't sound that concerned.
Well, of course, first of all, I cannot vote in the US. Secondly, I do not agree with everything Biden or Trump are doing. And I don't have to because I don't live in the US. But in the end, for me, from the Netherlands, we are, after the United Kingdom, the most transatlantic country in Europe. We are one of the biggest trading nations in the world. So that relationship with the US for us is crucial. And that means that whoever is president, being fairly elected in that country, we will work with. And it doesn't make sense to start commenting before the election is taking place. Oh, if this happens or that happens. Well, then you should become a US citizen. Then you should try to get yourself on the ballot.
All right,
which is not possible if you're not born in the US.
Because you've checked. No, but I'm curious about, the reason why people are thinking about this now is because we're thinking about, okay, how stable is the landscape that Davos has come to celebrate in some ways, which is this globalization and this idea.
Here, the issue is this, that we are always talking about globalization, and we need globalization. We need the multilateral system. But also the strong nation state. And what I think in Davos, for too many years, we have done too much is celebrating the multilateral world order, forgetting about the necessity that you also need strong nation states. And you need one and the other. It is not neither or, you need both at the same time. Because, for example, my country, what is my task? Strong economy and making sure that the Netherlands is safe. To have a strong economy and make sure the Netherlands is safe, we need the EU, we need NATO, etc. But it's in the national interest of the Netherlands. So we need both. And sometimes this almost gathering of the world elite discussing multilateralism as something in its own right is not right. It has to be connected and grounded in the nation state. That's my belief.
Prime Minister, I know you've only got 90 seconds left with us, so I want to finish on this. You've been at the forefront, I think, of this conversation where others have been lacking in Europe, getting Europe to look at itself about what Europe needs to do. The European model, for many, including us sitting here, feels broken. To rely on America for defence, for China for economic growth, for Russia for energy. It feels like in the last 10 years we've seen a real setback, a reality check. As you step back from the Netherlands, from your current role as Prime Minister, what's the new growth model look like? What does the new model actually look like?
EU. The internal market is the biggest internal market in world history, as NATO is the strongest defense alliance in world history. So the EU is successful. Don't tell each other or try to convince each other that the EU is broken. It is not. Yes, there are many issues we have to solve. But take, for example, our dependency on Russian gas. We have been able, in just 18 months, basically, to deleverage that dependency on Russia in terms of our gas supply. And in many other issues, the same. And when it comes to our collective defense, we have stepped up in terms of defense spending. Most NATO countries also being member of the EU. We have now Finland in the EU. Sweden will join as soon as possible. So I'm not that pessimistic. No, I wouldn't buy that story.
Prime Minister, it's good to see you.
Good to see you.
Your perspective. It's great to catch up, sir,
see you
as
next
always.
time.
Margaretha there, the Prime Minister of the Netherlands. Annmarie trying to press him there about the former President, Donald Trump. He wasn't biting, but one thing that the former Prime Minister, Margaretha, the current Prime Minister, soon-to-be former Prime Minister, has said often, that the former president was right to criticise NATO and to push the Europeans to spend more on defence.
Yeah, absolutely. And what has been more of a shock for a lot of these European countries that they weren't at 2%, and there is a war right now on the European soil. I know that's been a huge issue for the UK Defence Minister, who said at the Warsaw Security Forum, what is it going to take for these European nations to increase their defence spending when there is actually a war on our doorstep?
We've got a lot to discuss this afternoon. One more fantastic conversation still to come with David Cameron, the British Foreign Secretary. I want to check out the price action just briefly. 3 boards for you. Start with equities. We'll go to bonds, then to foreign exchange, going into the opening bell in about 38 minutes' time. Equity futures on the S&P 500, negative here by 0.6%. On the Nasdaq, we're negative by 0.9%. On the Russell, the small caps, down by 1.5.
I'm laughing.
In the bond market, I'm trying to carry on.
You tried to carry on, and there's complete chaos over here.
30-year. I've got the Dutch Prime Minister shaking my hand while I talk bonds. The Foreign Secretary of the United Kingdom's jumping in the chair. I'll carry on. In the bond market, yields higher by 4 basis points. On a 10-year, 4.1%. Your opening bell is about 37 minutes away. Now things can settle down. We're still live. I'm not sure David Cameron knew that. British Foreign Secretary joins us right now. How are you, sir?
I'm good. I hope I didn't get in your shot.
No. Just rattling through bond markets. Insignificant stuff. Don't worry about it.
That was the reason for it, but it didn't seem to work.
Let's get away from the markets and talk about your world.
Yeah.
It's a really, really delicate time. And what we're seeing in the West is seemingly an inability to restore order let's take the Red Sea, for example. How have Houthi rebels managed to basically shut down commerce in the Red Sea?
Well, they're doing it because they're backed by Iran and they've had weapons provided to Iran. And, you know, between the 19th of November and last weekend, they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions. And I believe that will make a difference.
You were part of the strikes that took place more recently with the United States. You remember about 10 years ago that you had to shove strikes in Syria because of a vote in Parliament. Just as a principle, is that something you think should be happening when the UK takes military decisions?
I think if you're taking urgent and immediate action, I think it's perfectly acceptable for the government to act. And of course, you've got to weigh up the operational security with consulting Parliament. But the warnings were given in Parliament. Parliamentarians were perfectly aware of what could well happen. And now there's been a statement in Parliament, and that's entirely right. Of course, there was the situation with Syria many years ago. I'd point also, we have taken action with Americans and others to get rid of the ISIL threat that was there in Syria and Iraq, and that was a very successful intervention. But clearly, look, this is about freedom of navigation. We want to have the freedom of navigation. It's vital not just for our economy, but for every economy in the world, including some of the poorest countries.
Including
and you can't
China.
have a situation...
Including China, just to jump in. And it's interesting to me that this could have huge consequences for trade in China, and yet China's not a part of what took place in the last week. Why aren't they getting involved?
Well, China did sign up to the UN Security Council resolution that condemned the Houthi attacks and said that nations had a right to self-defence. And so I think that is progress. But yes, if you're asking, is Britain a country that is prepared to stand up and work with allies and take action if we have the capabilities and if we can help? Yes, we are, because we think it's important that you don't always leave America to act alone.
Will the conflict continue in the Red Sea until there's a ceasefire in Gaza?
Well, obviously, you've got to look at all of these different things that are happening in the Middle East. I think the important thing is to try and deal with each of them. I don't think it was possible to go on allowing these attacks to continue in the Red Sea. But at the same time, yes, of course we want to work towards a resolution of the situation in Gaza. I've been very clear that should involve an immediate humanitarian pause. We need to get aid in. We need to get hostages out. That requires a pause. And of course, we've talked about a sustainable ceasefire because you've got to get rid of Hamas and its ability to rain down terror on Israel. But the best outcome would be moving from that pause to a sustainable ceasefire without a return to hostilities, without more destruction. But for that to happen, a number of things would have to take place. We'd have to see the Hamas leadership come out of Gaza. You'd have to see the hostage situation being resolved and resolved very rapidly. You'd have to make sure that Hamas was no longer capable of doing rocket and terrorist attacks onto Israel. You'd have to start working out who's going to govern Gaza and how, a new Palestinian authority. But I think that should be the ambition. That should be the plan, moving from an immediate cessation to deal with hostages, which is a pause, and moving from that into a sustainable ceasefire.
Whether it's Hamas, whether it's Lebanese Hezbollah, whether it's Houthis, all of these roads lead to Tehran. Where is going to be the Western response to Iran?
Well, we have delivered very tough messages to Iran, including I had a discussion with the foreign minister last week. And obviously there's a number of sanctions and other measures already in place. But I think it's absolutely vital that we send a very clear and unequivocal message to Iran that its behavior in supporting these proxies, whether it's Hamas or Hezbollah or indeed the Iranian armed groups in Iraq and Syria, its behavior is unacceptable, and we need to make sure that there will be consequences for this behaviour in terms of sanctions.
Say, actually striking a leadership like Qasem Soleimani?
No, I think what we need to look at is all the tools that we have in the toolbox. And obviously we have been using, for instance, sanctions against a number of people in Iran, and we need to look at how we can step that up if this behaviour continues.
There's a real question here as the leadership, and you're saying that there needs to be pretty strong measures taken, this needs to get resolved, etc. And then you see protests flooding the streets of London with all these people coming out to support Hamas, to support, yes, the Palestinian people, but also to really protest some of these actions. How does that complicate your job if you're losing a lot of the popular support?
Well, I wouldn't. Look, these protests, look, a lot of people feel very strongly about what's happening in Gaza, and I completely understand that because we have seen a huge loss of life. We've seen a lot of destruction. I support Israel's right to act in self-defense. I understand why they have to get rid of Hamas, but we all want to see fewer civilian casualties, less destruction. As I've said, I think there is a pathway to try and deal with this. We have a right to protest in our country. People are free to come out onto the streets and make their views known, but we have to work out what's the right thing to do to bring this to a conclusion. So it's often tempting in foreign policy to say the easy thing, let's just have a ceasefire that's comprehensive right now, but it won't work unless you deal with the problem of Hamas. And actually the thing that so many of those protesters want, which I want, which is a two-state solution where you have Israel and Palestine side by side. You'll never get that if Hamas are still in Gaza launching rockets capable of carrying out terrorist attacks. A two-state solution requires the bringing to the end of that situation.
I know you have to go. I want to squeeze in another question. Don't let me down, because I always say that British politicians have much thicker skin than American politicians do. So forgive the bluntness of this question. There is a 20-point gap between the Conservative Party and Labour. If we were to have an election right now, polls indicate your party would get absolutely trounced. What do you think is behind that? Do you think it's poor policy preferences or incompetence?
I remember sitting probably in a chair like this in 2013, 14, when I was Prime Minister. We were way behind in the polls. Everyone had written us off. They were saying, you know, start thinking about packing your bags. And we won that 2015 election. And we won it because we had a strong team with a clear plan. And that's what we've got now. We've got a very capable Prime Minister with a very strong team and a clear plan on how you deal with everything from illegal migration to growing the economy to sorting out some of these problems in terms of international security we've been discussing about. I didn't just come back into this government to come to great foreign gatherings like this and talk about foreign affairs, vital though that is. I came back as a full member of the team because I really believe in this team.
Well, it's good to see you, sir, and we're looking forward to talking to you more through the year ahead. David Cameron, thank you.
Thanks.
Thank you very much. The UK Foreign Secretary. David's going to exit left now, and we're going to carry on doing markets just to fill the screen as he goes past us. So let's do that right now because he's got to run. So let's get to the equity market on the S&P 500. On the S&P 500, we are negative by 0.6%. The opening bell about 29 minutes away. We have to round things up by talking about the last 30 minutes or so. We've talked about the reality check that's taken place for global leaders, given what's taken place, not just in the global economy, but also in the foreign policy hotspots at the moment for international security, Ukraine and Gaza. Big takeaway the last 30 minutes.
I think what Mark Rutte said about how you have to have strong nations in order to have internationalism, and the sort of increasing tension that this concept of just all leaning into some sort of multilateralism isn't going to work is something very apparent. But the companies are having the opposite tone, which is we got to still do our business. And our business, you have to look at the GDP of countries around this world, and that's where you're going to do your business, period, full stop. And you got to work with what you got.
Annmarie?
The internal perspective from the Dutch Prime Minister about looking in the mirror, and also the fact that Trump was correct on a number of these issues. And I'll say it again, Europe has had 4 years to sort itself out and prepare.
Plenty of fantastic conversation still to come from Davos, Switzerland. That does it for day 2. On day 3, Morgan Stanley's Ted Pick, Brian Moynihan at Bank of America, and a whole lot more. From the team at Davos, Switzerland, this was Bloomberg Surveillance. This is Bloomberg.